example, they are adding the additional amounts for age and blindness on the earned income.
Earned income?
Yeah.
Okay. No, that's not right. If you were to go to the publication 17, they would not add it. They would not be adding it there.
Yeah, that's why I'm confused when I'm reading because her wages from a part-time job of 2.9, then they add 2.9 plus 350 plus 1,550 because she is legally blind.
Let me try to find it. Give me just a second. Let me open that up. You said it's on which chapter is that again? Sorry.
Unit 12,
12. Okay. Let me call it up on my end. In fact, I'm going to go ahead and share my screen, and then you'll be able to see what I see.
page 220.
Okay. Let me go ahead and get there. We'll look at it together.
But I will try to do the 1,050.
It says there's no page 220, but that's because of the way the document's put together. So let me just zip through it.
Yeah, I'm there. I've got everything printed out and tabbed. Crazy.
Okay, so which example are you looking at?
Marlene is 19, single
and legally
blind.
She's claimed as a dependent on her parents' return. I've got it up on the screen for everyone to look at. So the question, just to let everyone know, she's asking a question about that little shortcut way or the little visual way that I calculate standard deduction for a dependent. And she's saying they're doing it differently than I am. So let's take a look at it. Marlene is 19, single, and blind. She is claimed as a dependent on her parents' return. Marlene has interest income of $1,300 and wages from a part-time job of $2,900. Because she is claimed as a dependent, Marlene's base amount for the standard deduction is $3,250, the $2,900 plus the $350. Because she is also blind, she is also allowed a standard deduction amount. Oh, I know. What's this? Yeah, let me look at something here.
You're giving her the additional for blindness.
Yeah, they're giving her the additional for blindness. Let me look at something, okay? Be 13,600. These numbers are wrong. That's not the right number for an additional standard deduction amount. The right number is 1,600 for 2018.
Yeah.
I'll bet that's 2017. I'll bet they made a mistake and didn't update that.
No, that's what I'm telling last session that this our reading materials is based on 2017.
Yeah, they're talking about 2017.
Yeah.
Okay, guys. Ryan? Hey, Ryan, can you hear us okay?
That's why I'm...
Are you hearing that? They've got a mistake in the book. There's their material while the front of the book is saying 2018-19. They've got 2017 amounts still in the book, at least in several places, just a heads up. That's a 2017 amount.
Even the standard deduction table is for 2017.
Yeah. Yeah, so it may be, Ryan, that they never got this updated. So look, I just wanted you to be aware of it, Ryan. Look, guys, keep this in mind. If it's 2017, just plug in the 2018 numbers, okay?
Yeah.
And run it yourself. Okay. So thank you for pointing that out. It's important to know that our book, even though it says they updated it 2018, it wasn't 2018 yet. So don't know why that's happening. I apologize. It was supposed to be 2018, but here's the good news. The good news is the 2018 material, okay, is just a change of the main things I want you to focus on are the changes in the amounts. So the fact that the amounts are different, we're giving you the amounts. Okay, just plug in the correct amounts. That's what I would suggest with this. Also, keep in mind that there are some changes to the actual rules, but I've been telling you when there's changes from 2017 to 2018 also.
Actually, okay, in our reading materials, there's always a footnote, and yeah, okay, telling that there is a based on the job acts.
Yeah,
like
right.
like the 2%. Like this, the Tax Cuts and Jobs Act eliminates the deduction for all miscellaneous itemized deductions subject to the 2% of AGI after December 31, 2017.
Right, right. Remember, I told you that we were not going to cover that when we looked at the Schedule A, which I don't have a copy of up here. Let me get a copy up of it, because this is where I was going to start today anyway. So give me just a minute and I'll pull it up. Seem to have lost where I put it.
I just want to confirm that your steps is still the correct one.
It is. The only problem with my steps is it'll help you calculate something really fast if you need to. But it's not stating the rules that they may question you about. But look, I think if they're going to do anything, they're probably going to ask a question and say, okay, what's the standard deduction amount? In which case my steps would work. But make sure to use the 2018 because that's what you're going to be tested on after July 1st.
Yeah, so this is not correct that you add the additional amount for age and blindness to earned income.
No, you add it correct. You add earned income plus 350, which is what they did in that example. That part was right.
But they add 1550.
Yeah, but that's because they had the numbers wrong for 2018. If we were doing 2017 numbers, it would have been fine. They because it was 1550 before. That was the additional amount a year ago.
No, what I'm asking, disregard the amount. They are adding additional amount for age and blindness to earned income plus 350.
Let me look at it again. See what? It's because
the last statement, her standard deduction is 4,800. 4,800 is earned income plus 350 plus the additional amount for age and blindness. That is what I'm asking.
Yeah. You know what? Let me look into that. Let me make sure I didn't miss something in there. I see what you're saying. Let me look into that and I'll get back to you, okay?
Okay, we can proceed, okay.
Yeah, I hear what you're saying. Certain income plus
yeah, let's just come back after you.
For a single person, 63.50 standard deduction. Yeah, you know what? It's a possibility that that this is a change that was made a couple years ago. I'd have to double check that. Let me double check that because this line right here, oops, that I'm reading right there does seem to suggest that you would add some more to the standard deduction. I want to check with IRS, my IRS stuff. And if I'm wrong, I'll just add a step in there and get it out to you. Because if I'm wrong, all you would do is add in the age and blindness additional amount to the standard deduction amount. So, okay.
Okay.
So no, that's a great question, and I appreciate that. And the thing is I do my best to stay up on everything. So if I missed a change, and that would not have been just in 2018, if I missed a change, it probably happened earlier. So, by the way, that's one of the dangers when you're relying on computers after you get your degrees and licenses. It's easy to start relying on the computer. You still want to know the tax law, and that could have been a mistake. But how often do we do dependent returns, where you're probably going to do 2 or 3 a year, but the computer always calculates it for you? So it's easy to make a mistake on that when you're not keeping up exactly on the law like you should. Okay.
Okay, thank you.
Yeah. So remembering on you should have your copy of your schedule layout, should have a copy of your Form 1040 along with the schedules out. So remember, what line on the Form 1040 do you put your deductions? What's that?
Yep.
Sorry, I cannot hear anyone. Look at your Form 1040. Tell me what line do you put your standard deduction?
8.
Line 8. That's
Yeah.
line 8. What line, if you choose to take itemized deductions, what line will you take itemized deductions on?
Line 8 also.
Perfect. Okay. So now we have something that's also called an above the line deduction. What's the other name for above the line deductions?
Adjustments.
Adjustments.
Adjustments, that's right. Adjustments. So adjustments are above what line? What's the line? It's okay. Remember, we have above the line deductions and below the line deductions. What is the line between those two?
Above the line is line 6.
I didn't mean what number.
7.
What was the line called?
AGI.
That's right,
Tot-
AGI. AGI. Total income minus adjustments, above the line adjustments, gives you AGI. AGI is that dividing line between the two. So remember
Line
our
7.
form right.
That is
Remember
line
our Form 1040 calculations. Total income minus adjustments gives you AGI. Then AGI minus deductions gives you taxable. Taxable income. Okay, so don't worry about so much above and below the line. You'll never be tested on that. That's just a practical thing to keep straight, that AGI is an important concept. All of everything before AGI is dealing with your income, what's got to be included, what can be included, and then what can you adjust from it, or in other words, deduct from it. Those are above the line because we have not gotten to the AGI line yet. Once we get to the AGI line, that becomes the dividing point. And what line is AGI put on?
7.
7.
Okay. And where do we put adjustments? Where on your tax return do you mark adjustments? And I'm talking 2018.
Schedule 1.
Schedule 1. Which part of Schedule 1, the top or the bottom part? Half.
Adjustments are on the top half, aren't they?
Second, bottom half.
Adjustments are on the bottom half. What's on the top half?
Additional income.
Right. There's some additional income that was not on the Form 1040. So sorry for those that are having to learn this new weird form, but that's how it's put together. Okay. So you can take standard deduction or you can take itemized deductions. Okay. Now we were talking, now let's look on the screen for a second. we were talking about itemized deductions. Where do you report itemized deductions? Where do you list them out, itemize them? What form?
Schedule A.
Schedule A, that's right. Now, you recall that we did an overview of the Schedule A to start last session. We have medical and dental expenses as a major section. We have taxes paid. Then we have interest you paid. And then we have gifts to charity. Those are the ones that we're going to focus on today. Do remember that we discussed casualty and theft losses. Casualty and theft losses starting in 2018. You can only take casualty and theft losses if you are in what?
Federally declared disaster area.
That's exactly right. If you're not in a federally declared disaster area, you no longer get to take a casualty and theft loss on your personal income taxes. Other itemized deductions included unreimbursed employee expenses. It included it also was called a Form 2106 expense because that was the form you used to have to report it on. It also included the amount you paid on your to have your tax return prepared last year. You used to be able to deduct that. You used to be able to deduct the amount that you paid to your investor if you had an investor. You could deduct all those things right there. And most of them were subject to the 2% tax, 2% limit. 2% limit worked the same way as the medical, which we'll go and talk about in a second. So this doesn't exist anymore. It's just gone. Okay.
So the stuff we read, at least stuff I read in Unit 13 over casualty, theft losses, and all that, it's 2017 tax law. It's covering how you can have the 100% rule, the 10% rule.
Yeah. Well, remember I told
loss between if it's just in a federal disaster area and stuff. And so, no, all I'm pointing out is that the stuff we're being asked to read over, to review, and ask questions about isn't what you're saying we're going to be tested on. So it's a little, not an awful lot of information in there. So
that's why I said just skim over it. You
wanted us to ask questions about it today, so you wanted us to read through it all. So I did.
Good. I appreciate it, Gary. No, that's good. Look, the reason is I've been a little confused, however, about the book. The book seems to be covering 2017 tax law, at least on these items here.
Sure does.
And yet it's supposed to be 2018 book. So we just discovered, though, they have 2017 other material in there. So I think there's some confusion in there. I still think as a practical matter, it's good to be familiar with it. I just don't want to spend any significant time with these. Okay, because I have my doubts whether or not you're going to get tested on this. Other than
casualty and theft losses only being allowed if you're in a federally declared disaster area, then it is subject to the $500 rule, not the $100 rule. Then is that correct?
Yes.
Okay, that's all I really wanted to clarify. So.
Yeah. Yes, that's correct. So there's been some changes. We haven't gone over it.
I know.
And
you said you weren't going to, but
no, I know. I wasn't. I know. I was repeating it for the recording.
Oh.
The thing is we'd gotten to the place we almost had stopped going over this even when it was on there, because if you got a question, you were maybe going to have one question on the casualty and theft loss. It's just tough because we got a lot of material to get through, and we don't want to spend too much time on something you'll hardly get tested on if you do it all. What I do want you to know is federally declared disaster area. You got to be in that. I could see easily getting a question right if they even ask a question on this, if they asked such a question. So, all right. So, guys, I apologize. This is the first year we're doing this, and this is exactly why there's a little bit of confusion with the book. We were led to believe it was 2018. It seems like there's 2017, which it would explain why all of this stuff is in there. And we'll figure it out from there. Okay? All right. So, this is what I want you to hear. Casualty and theft losses, only for federally declared disaster areas now. It still has a couple of rules which you guys haven't learned, but there's still a 10% rule and now a $500 rule where you got to limit what you get to take to that. Don't worry about it more than that. That's all I just want you to know, because that might be enough to help you pass a question if they threw a question at you from here. Itemized deductions, I really don't want you to worry about it. I'd just like you to be familiar with it, and that's why I asked you guys to read through the chapter, but just read through it. Don't really try to study it, okay? Okay, so we ended last session talking about medical and dental expenses. Let me ask you some questions about what might be a qualifying medical and dental expense. Are over-the-counter medications qualifying medical expenses?
No.
No.
That's right. Are amounts you pay out of your own pocket after tax for health insurance qualifying expenses?
Yes.
Yes. If do you get to take expenses only for yourself or for the people in your family as well?
Family.
Family.
Yeah.
So your
Dependents.
your spouse, and your dependents. Exactly right.
Yes.
If I incurred an expense in 2017 but did not pay it till 2018, which year do I put it on my tax return? And I'm talking medical expense.
2017.
Okay, if I incurred
Incurred, yeah.
if I incurred it in 2017 but did not pay it until 2018, which year do I put it on my return?
2018.
2018 is always the year that you pay it, not the year that you incur it. So if I have a child who needed braces in 2017, and there's $2,000-$3,000 whatever braces cost now, and but I didn't pay it until I made payments on it starting in 2018, paid it all off in 2018. I'm going to put that on my 2018 tax return. What if I have a child who I paid expenses for, medical expenses for, in 28, excuse me, let me back up. Let's say I incurred the expense in 2017, okay? And I claimed her on my tax return in 2017, but I did not pay it until 2018, but when I do my 2018 tax return, she's no longer on my return. Can I still take that expense?
Ooh.
Wow. Yeah.
Yes.
Because you paid it.
That's right. The reason is that's one of the rare times. Keep in mind, it still follows the rule. It's you claim it in the year you actually pay it. But if in the year you incurred it, you were able to claim that person on your return, you still get to take that expense in the year you pay it. Does that make sense?
Yes.
Yeah. Yeah. A little bit tricky, but yeah. Okay. Can I take funeral expenses as a medical expense?
No.
No. That's exactly right. I'm trying to think of some other big ones you might get tested on. Can I take medical expenses for vet expenses?
No.
No. Okay. So, do I get to take, once I figure out all of my allowable medical and dental expenses, do I get to take 100% of that?
No.
No. It is going to be limited. What's it going to be limited by?
7.5%.
7.5%.
You're exactly right. All of you said the same thing. 7.5% of what?
AGI.
AGI.
Perfect. And what's left over after you subtract that out, that's the amount you get. So there's you multiply the 7.5%. Sorry, guys, I'm trying to highlight the right thing, and my computer's just not doing it. But anyway, you subtract it out and put it on line 4. What's left over? Okay, so now we're going to start talking about taxes that are paid on here. So let's do a quick level overview. Now, this is where those that are familiar with the older version of Schedule A, they've rearranged it a little bit, but it's not too bad. State and local taxes, there's state and local taxes, income taxes, or sales tax. So it's income tax or sales tax. You don't get to include both of them, but you can include one or the other, whichever gives you the bigger deduction. You also get to include real estate taxes. You also get to include personal property taxes. So you add all those taxes together that you're allowed to include, and then there are some limits on the taxes, okay? And then there's some other taxes that you might be able to include, okay? Now, the limits, let's talk about the limits, because that's not going to be in the PowerPoint presentation, because the PowerPoint presentation was relying fairly heavily on the 2017 material. So you either take, once you've added up all of your taxes, all of the state and local income taxes, real estate taxes, and personal property taxes, you add all that together on line 5D. Boy. Sorry, guys, I keep trying to highlight something and it just won't highlight right. You put everything on, you add it all together in 5D, and then you take the smaller of either 5D or $10,000. Okay, so all that's saying is from the taxes that you are able to add together on line 5, A through C, you get to take up to $10,000 and no more. So they're just added. What has happened is the new tax law starting in 2018 simply took the same taxes that were allowed before and just put a cap on it. What's the cap?
10,000.
And it's half that for MFS. So just remember that. 10,000 for all filing statuses except for MFS. It's half that for MFS. Then you take that and you add it to other taxes. Other taxes would include things like foreign taxes that you paid or something like that. There are other types of taxes that are out there. So you just simply add to that on line 6 other taxes and add it all together. So what we're going to do is we're going to go into that and delve into this a bit deeper, okay?
Right.
Okay, this is just to make it a little bit easier to see. So let me do this. And I need to get my little chat bar up in case somebody types in a chat thing, I can see it. Okay, so first of all, which taxes can you deduct? Okay, there's different kinds of taxes. There's fees and charges. Fees and charges that are expenses of your trade or business you can deduct. Would you deduct those? So you can deduct those, but would you deduct those on a Schedule A?
I would think you'd put it on a Schedule C.
You're exactly right, Sheila. That what they're talking about here is a business, a trade or business income. If you're running a business, yeah, you can deduct fees and charges that are part of your business, but you put them on your Schedule C. Now, remember when we did a Schedule C and talked about self-employment income? That's what they're talking about. So, but if you have fees and charges that are not part of a business, like charges for getting your driver's license or parking fees, or charges for water bills, are you able to deduct on your personal income tax your own water bills for your own personal home?
No.
No.
No. Are you able to deduct fines and penalties? Oops, sorry guys. Move that on you. Can you deduct fines and penalties?
No.
No. So you cannot deduct fees and charges. See, I would have done this a little differently. You cannot deduct fees and charges on your personal income taxes for things like car inspections, driver's license fees, water bills, fines and penalties. You cannot deduct those things. You cannot deduct these things unless you're running a business. And that makes sense. If you're running a business, it's actually part of running the business. Income taxes. On your personal income tax return, you can deduct state and local income taxes. You can deduct foreign income taxes. What's an example of foreign income taxes? Can somebody just tell me what that is, either define it or give me an example?
Taxes paid on foreign income you earn from like either through an investment in a foreign country or
Yeah, that's exactly right. Spot on, Garrett. Good job. Employee contributions to state funds. I'm trying to think the one in California. I'm trying to think of what that is called. SDIs, the state disability insurance. You would be able to deduct that as a tax also. So here's the thing: state and local income taxes, foreign income taxes, and employee contributions to state funds. The big ones I really want you to focus on are state and local income taxes and foreign income taxes. You can deduct those on your tax return, and you do that on Schedule A.
Question?
Yeah.
Yeah.
WBF, Workers Benefit Fund, in Oregon, is that a contribution to a state benefit fund?
I don't think so. I'm trying to remember why that would not be included. I apologize, Sheila. I don't have a great answer for you. I'd be
Okay.
glad to look into that.
Sure.
I don't believe it is. It has to meet this technical state requirement, and that's
Okay.
why I don't really want us focusing too much on this, because
Sure.
again, this is the kind of thing that you'll run into a few times, especially in Oregon. You won't run into it a lot, but
But I do taxes, and that just came to mind.
Yeah, no, and that's a great question, and I believe it's not. I just can't tell you exactly why it's not. I'd have to. It probably is not meeting the definition here.
Okay.
See, again, guys, what you're seeing when I don't know something, I've been doing this for years, but what you're seeing is, notice nobody knows everything, and nobody's going to keep all the little details straight. You got to know where to find the answer when you don't know something. That's the key. But for passing a test, we're trying to get you to pass a test right now.
Right.
Then also to help you understand enough of it, not only to pass the test, but that you can, after you pass the test, you can actually do a real tax return. And if you get stuck, you know where to go to find the answer. So now, what can you not deduct about income taxes? Well, you cannot deduct federal income taxes. So let's make the distinction. What you pay to the IRS, you cannot deduct that, but what you pay to Oregon and other states, you can. What you pay to other countries, you can. You cannot deduct employee contributions to private or voluntary disability plans, so private ones. You cannot deduct state and local general sales tax if you choose to use the state and local income taxes. Kind of funky here. It just, all the rule is you can deduct state and local income taxes or sales tax, one or the other. You can't deduct them both. That's all it's saying. General sales tax. This is state and local general sales tax. You can deduct that, but you cannot deduct it if you choose to use the local income taxes, state and local income taxes instead. A lot of this is repetition. That's why I'm not a big fan of this. I think it's easier just to remember certain things. Well, let's go through it. Then I'll clean it up for you guys. Okay.
Okay.
Taxes that are expensed, other taxes. Taxes that are expensed to your trade or business, you can deduct that. But where are you going to deduct that?
Schedule C.
Schedule C. Taxes on property producing rent or royalty income, you can deduct that. Will you deduct that on a Schedule A?
Have to find the Schedule A first.
Well, just look at the name. You don't even really need to look at it.
Rental income.
It's rental income. Where do you report rental income and expenses?
Would that be Schedule A?
C.
Somebody tell me, we went over this. We went over this.
C maybe.
No, not C.
E.
Rental income, Schedule E.
E.
What'd you say, Garrett?
Same as the last person, Schedule E.
Oh, I'm sorry. I thought I heard Schedule C. It's Schedule E as in echo. E as in echo. So if you're got taxes that are expenses of your trade or business, that goes on a Schedule C as in Charlie. Taxes for producing rent or royalty income. Remember, rent and royalty income is reported on Schedule E as an echo. That's where you'd report taxes related to that. There are other taxes. You can deduct 1/2 of your self-employment tax, but where do you deduct that?
C again.
No. Self-employment and 1/2 self-employment tax?
Oh.
1040.
1040, what part of the
1040?
1040? You're right.
Mine,
Let me ask you this. What type of deduction is it?
It's a self-employment deduction,
Right, and it's in the group of deductions that we call what?
additional income and adjustments.
Adjustments. Remember, total
Schedule
income
1.
minus adjustments. That's the key. Schedule 1, that's right, Schedule 1. So what they're showing you is there's all sorts of things you can deduct, but they don't all necessarily go on a Schedule A. They may go other places. Look, you cannot deduct at all excise taxes, taxes on gasoline, and so on, per capita taxes. Look, if you don't even know what those are, don't worry about them. Just know you cannot deduct taxes like for excise taxes or gasoline taxes. What about personal property taxes? State and local personal property taxes. You can deduct those. You do deduct those on a Schedule A. Personal property tax, I think we're going to get into it. Customs duties that are not expenses of your trade or business are not going to be able to be deducted. Real estate taxes you can include. Foreign real estate taxes you can include. If you're a tenant, or the tenant share of real estate taxes paid if you're in a co-op, you can include. So real estate taxes you get to include. Here's what I want you to remember. There are many different kinds of taxes that you could potentially include. Here's the point. If it's business related, you put it on which schedule?
C.
C is in Charlie. If it's rent related, you put it on which schedule?
E.
is in Echo.
E is in Echo. If it's related to passive income or royalty income, where would you put that?
C.
Where do we report royalty income and pass-through entity income, passive income of that nature? We just touched on it a couple, 3 sessions ago.
Schedule E, isn't it?
Yes, that's right. Schedule E is an Echo. It's another part. Remember, rent income and royalty income are both reported on page 1. I keep saying passive. I mean flow-through income is reported on page 2. Okay. Okay. So if it's business related taxes, it goes on Schedule C, as in Charlie. If it's related to rent or royalty or pass-through entity, it's going to go on Schedule E, as in Echo. If it's self-employment, 1/2 is self-employment tax, just remember that's an adjustment that you put onto your Form 1040, specifically Schedule 1 of the Form 1040. It's an adjustment to your normal taxes. Everything else that you're allowed to take is on Schedule A if you're allowed to take it. Okay?
Okay.
Okay, so I know that was a high-level overview, but I want to drill into it and it'll make a little more sense. So state and local, I did add in the maximum. That's good. State and local taxes. So we're going to talk about those. You can take state and local taxes. Here's the maximum that's allowed, $10,000. How much for MFS?
5,000.
5.
That's right. That's right. Perfect. So what do you get to take under this? You can take either income or general sales tax. Either income or general sales tax. So income taxes, where do you get those? They can be withheld. Income taxes can be withheld, or they can be estimated, or they can be other. So withheld taxes are what's withheld from your paychecks. Estimated taxes are what you send in quarterly based on estimates of your income. Normally, most people that do this are usually self-employed. Okay, so if you have withheld taxes, where are those going to be reported? Well, here's some list here. W-2, W-2G. What's a W-2G?
Gambling winnings.
That's right. 1099G. A 1099 miscellaneous, 1099R. Which of these 1099s has self-employment income on it?
1099 miscellaneous.
And which of the 1099s has retirement income on it?
1099.
99R.
Perfect, perfect. Good job, guys. So you can potentially see withholdings in all of these. Now, Estimated taxes, that's where you're sending the money directly to the IRS, so there will be no reporting. The only reporting is what you did when you sent that in. And then there's some other types of income taxes that you might have paid. Prior year balance due, when you did your prior year return, or mandatory contributions. So Sheila, you were asking a question. This is what we were talking about a moment ago, where you can deduct it if it meets certain qualifications.
Right.
Here's a list of them. Alaska Unemployment Compensation Fund. Geez, I totally forgot about that. California Disability Fund, California Paid Leave, New Jersey. So I don't see Oregon in there. I couldn't tell you exactly why it's not. I'd have to drill into the actual rule itself. But these, let me tell you, the ones that usually show up on Oregon's tests anyway, they often will ask, they often give you a little simple problem and say, list the taxes that you can include. Well, Alaska Unemployment Compensation, this is one they often will put in there. So just let you know. Don't know what IRS will do, but I would say just kind of be familiar with the different states that are involved. And if you see one of them, there's a good chance, if it's a compensation fund from one of these states, that you're going to be able to include that. Okay? Does this make more sense than the chart? It does to me. But, everyone learns different. The chart we went over, I think, was confusing. I think this is a lot cleaner. It's a flow chart that at least you can see where what's included. Okay. So now you can take income taxes, state and local income taxes, or general sales tax. This can be beneficial in the states that have sales taxes. Washington has it. Nevada has it. Alaska has it. Texas has it. Florida. What state is that? Don't worry about it.
Wyoming, isn't it?
Yeah.
Yeah, it's Wyoming.
Yeah, that's Wyoming. I had to stop think. That's Wyoming because
Montana. South Dakota.
Yeah. Yeah, South Dakota, North Dakota. Anyway, this is not meant to be a geography lesson, so don't worry about it. The point is the ones you'll see in real life a fair amount of, you're actually going to see a fair amount of this if you're in Oregon. Okay. So, if they have, I forgot something, guys, because I knew California has a sales tax too. Here's the thing. This is actually stating these are places that do not have any income tax. No income tax here, no income tax here, no income tax here, and so on. Those are ones without income tax. Where state income tax is limited to dividends and interest income only, that's New Hampshire and Tennessee. Do I want you to remember that? No. Do I want you to know that regardless of where you're at, some states are going to have both income taxes and sales tax? Some states are going to have only sales tax. Some states are going to have combo. So, does Washington have only sales tax, only income tax, or both?
Sales tax, no income tax.
That's correct. Oregon, income tax, sales tax, or both?
No sales tax, income tax.
That's exactly right. That's exactly right. So, all right. So I think that's good enough. So what's the point of this? The point is you can take one or the other, but not both. And if they happen to have both, calculate both and take whatever is the best. Okay. So when you're taking general sales tax, how do you deal with that? You want to take your general sales tax and you can take the actual taxes that you paid or the optional sales tax tables. Now, actual taxes that you paid, do you think I think it would be a serious problem to keep absolutely, if you're living, say, well up into Washington, it would be really hard to keep all of your receipts every time you buy something and add up all of your actual taxes that you paid. I mean, we're talking every time you go to the store, every time you go out, everything. That would be hard. So very few people use actual. they can use the sales tax tables where you go to the state and there's a table for each state that's involved, and you just go there and you pick it up. Anyway, that's what most people use. So, but you can use actual expenses or the sales tax tables, one or the other. When you're using the sales tax tables, make sure to use the deduction worksheet. Make sure to use the deduction worksheet so that you're calculating it right, and the optional state and certain local sales tax tables. And this is how you do it. We'll take a quick look at it, but we're not going to spend time doing it because you're not going to get this kind of tested on it. In the tables, you find where the state where the taxpayer lives. Okay, then you locate the row associated with the taxpayer's income. Okay, their AGI. Then you locate the number of exemptions the taxpayer claimed on the Form 1040 for the state where they resided. And then so you got this table. So you get into the chart into the chart for that state. Then you find out their AGI, and along the top the number of exemptions, and then you find the intersection point, and that's the amount that you'll take. And then you just follow the rest of the worksheet to make sure there's nothing else. See, there's other things you can add to it, like the taxes, general sales tax that you paid for buying a special item like a car or a boat or something like that. You add it all together, and that's your general sales tax amount. Okay. Now, does that sound confusing? It is, only because the way you see it here, it's not that bad. But here's an example. Andy and Kayla Harper, MFJ, they have 3 dependents. Their AGI is $39,900. They have tax-exempt interest of $200. They're Alabama residents, so their state sales tax rate is 4%. Their local general sales tax rate is 0.5%. They purchased a new car and paid sales tax of $582. So no receipts for actual expenses, so use the tax tables. So this is an example of one and how we're getting at it. The first thing they do is they're finding and this is 2017, so realize this will be different for 2018, but what's the first thing they do? They go to the sales tax table and they look for the one that says Alabama. That's the first thing we do. Then we go to the amount of their income. Their income level was at least $40,000, but less than $50,000. How many exemptions do they have on their return?
5.
5. So there's the 5. So the intersection point between these two is there. And there's their sales tax rate for 4%. That's really all you're doing. And then you plug it in, $678. See, they plugged it in. Did you live in one of these special states? No. Did your locality impose a general sales tax? Well, yes, they did. How much was it? 0.5%. Did you enter 0 on line 2? Oh, yes, we did. So enter the state general sales tax rate. That's 4%. Divide line 3 by line 4. So 3 by line 4. So they're figuring out the percentage rate for the two. There's the percentage rate. Now they're calculating, and I'm just jumping around to tell you what they're doing. They're figuring out how much of the amount up here that you already have can you take for local sales tax. Well, it's based on a percentage of these two. That's all we're doing. So another $85, and then you add it all together. So a little bit confusing. I don't want you to spend a whole lot of time with this. What I do want you to know is it's not that complicated if you literally just take it line by line. I'm a little bit rushing through this because I don't want to clutter your brains up with a bunch of stuff that you don't really need to do right now. Remember, I'm interested in you passing a test. So if I was to go past this and I say, hey, they have the ability to take $500 general sales tax or $1,000 local, state and local income tax, could they take either of them?
One or the other.
They can take either of them. That's right, one or the other. And which one would be best for them to take in that example?
Everyone's higher.
The higher one, which is $1,000 in that example. So that's why I said I'm not interested in you guys focusing too much on this kind of detail. I don't think you would have any trouble walking through this and getting the right answer in real life. I just don't think we need to. I don't think we need to go through that. So that's why I'm saying I'm not worried about it. All you're doing here is you're calculating different percentages amounts, and then you're just kind of adding everything together of what you are able to take, and it all totals up. By the time you do this calculation and this calculation, it all totals up to that amount in this example. The rest of it doesn't matter as long as you know what. To calculate sales tax, you're going to have to go to the sales tax tables for that state, know the income amount and the exemption amount, and then you got to go to the table to really calculate how much they actually get. That's what you would do. Okay. Oh, there was one thing I skipped over here that I shouldn't have. This additional amount here, what's that for in this example?
Well, it says specific items.
Right. And what specific items in this example, do you recall what they bought?
Car?
Yeah. Yeah, they paid $582 in sales tax for a car. So $678 is for their general state sales tax. $85 is what they were permitted for their local sales tax. $582 is what they were permitted for sales tax on a certain specific items. It gets added together. There you go. That's all they're doing. So, before we go into real estate taxes, any questions about general state and local income taxes or general sales tax? Guess everyone feels okay with that one? Okay. Real estate taxes. This is another thing you can deduct on your Schedule A. They can only deduct taxes on real estate that you actually own. So a taxpayer, this bears repeating, a taxpayer can only deduct taxes they paid on property they actually own. They cannot be living with somebody else, like maybe, boyfriend, girlfriend living together, and she's paying the property taxes for him and she wants to take it on her return. She can't. She doesn't get to take that. So I've seen realistic situations where, and I've seen it like this, a son, I'm thinking about a real situation where a son was living with his parents. They were both elderly. He had plenty of income. He was living with them more to take care of them. Not that he had to, but they had a nice big house. It was comfortable. So he was living there. He was paying the taxes. He came into me and wanted to deduct that because he had been paying all the taxes. Did I take that or did I not take that? Not. I could not take it because the property is not in his name. Okay, what are real estate taxes? These are taxes that are assessed on the value of the property. It's not a flat fee. If the more property, what the property is worth, the more expensive it is, the more you're going to pay taxes on it. So it's assessed on the value of the property. So the more valuable the property, the more you're paying in taxes. That's an assessment on value. When the property is sold, the buyer and seller deduct a portion of the sales taxes based on the number of days each person owned the property. So if I have property that I just purchased on say July the 1st, let's say I buy a new piece of property. On July the 1st, I buy the property. Who gets to take the taxes for the first half of the year? The buyer or the seller?
Seller.
That's right, the seller. And who gets to take the last half of the year?
You,
The buyer.
Me, the buyer. That's exactly right. Monthly mortgage payments that are placed in escrow for taxpayers can deduct only the taxes that were actually paid. What they're talking about is escrow. When you buy a house, you might or might not use escrow. Okay, escrow means to make sure taxes and insurance get paid. Some banks or mortgage companies will actually say, okay, you've got X number of dollars you got to pay for the actual mortgage every month. But we're going to add an additional amount in there so we make sure you save enough also to pay the real estate taxes and the insurance on the house. And they'll establish that amount using their formula. Okay, that additional amount that's set aside is an escrow. It's really your money, and they'll actually make those payments for you. Well, it's not the amount you put in there. In some years, you might put in more than was actually paid in taxes. In some years, you'll put in less than was paid in taxes. It's the actual amount that was paid in taxes during the year. That's what you actually get to take on your tax return, the actual amount paid. And where do you deduct real estate taxes on your Schedule A? Which line? So take a look at your Schedule A and tell me which line do you deduct real estate taxes? Of course, those that want to cheat, the answer's right on the screen. But I want you to see it. I want you to look at your Schedule A. That's what I'm holding up here, Schedule A. I want you to look at your Schedule A. This will help you learn. Does everyone see the line 5B? That's where you'd put it. Okay? All right, so let's do an example, an illustration. Franklin owns his personal residence, a vacation home, and vacant land. So he really owns 3 pieces of property: his personal residence, a vacation home, and vacant land. He paid the following real estate taxes this year. On his personal residence, he paid $2,200 in real estate taxes. On his vacation home, he paid $1,289 of real estate taxes. And on some vacant land, he paid $325.
Yeah.
He gets to take all of that. You add it all together. He gets to take it all.
If I own a house with my brother and
Yes.
I pay let's say the taxes are $2,000 and I paid the taxes, I get to take $1,000?
You guys that's a great question. You can actually divide that however you want. As long as your name's on the title and you paid it, you can take it however you want.
Oh.
Or you could divide it up.
Got
Because
it.
both of your names are on the title, so you could divide it up 50-50. You could give it all to him. He could give it all to you. You can literally divide it however you want.
Interesting.
Yeah. Just as long as the IRS says in the end you can't deduct more than the amount that you paid total.
Right.
Guys, the reason is real estate is not considered dividable. In real estate law, what happens is if you even own 1/100th of 1% of the property, you own 100% of the property. You have a whole 100% right to all of it. They cannot divide any portion. So if your name is even on it for the smallest amount, you have 100% of the right of the property. So you can divide it however the two of you or however many people are on it want to divide it. You all have an equal right to it. So that as long as the total sum is 100% amongst you, you guys can divide it however you want.
Okay. Yeah. So the total in this example is, when you add it all together, is $3,814. And where does he report that? Where does Franklin report that?
I see.
What line on Schedule A does he report that?
5B.
5B. Okay, cool. I wasn't sure if somebody answered there. Marie pays state motor vehicle registration tax. Okay, I don't want to go through this. Too much detail. Sorry, guys. The reason is they're getting into personal weight and stuff like that. I think that's too much detail for what we want. I want you to know the big level concepts. So, line 5A. If they have state and local income taxes or general sales tax or both, you put that on there on line 5A. Line 5B, deductible state and local real estate taxes. Real estate taxes. Line 5C, personal property taxes, if any. 5D, add the amounts together. 5E, you limit 5D to $10,000. So whichever smaller, the amount on 5D or $10,000. And if you're MFS, what's the amount you limit it to?
5,000.
1,000.
Yep. And then line 6 is the actual amount of taxes that you're allowed to take. Look, at moments, I think they make this a little more complicated than they need to. That's why I skip over some illustrations. We will be posting this, by the way, this PowerPoint online and on the website. And so if you ever want to go over it and go through some of the details that I'm skipping over, that's fine. Okay, so here's the illustration. Chantel is divorced. She has 2 dependent children who lived with her all year, Mark and Beverly. She pays all the expenses of maintaining their home in Nebraska. And she has W-2 here, which you're looking at, and it has state withholding. So which box has the state withholding in it? Which box number?
17.
17. That's right. Good job. And how much is in box 17? Can you guys read that?
1863. You rounded up.
Yeah, that's right. 1863. Then she's just rounding there. So that's fine. So that's the amount that actually is withheld. So her expenses, she has a minivan that costs $39,999. She paid sales tax of $2,199.95. Which is at 5.5%, which is Nebraska's sales tax rate. She paid real estate tax of $1,025, and she's paid personal property tax based on the van's value. Look, there is something I skipped over, that personal property tax. Personal property tax is a tax based on the value of personal property. In other words, the more expensive the van in this example, the more tax she's going to pay. This is not the same thing as paying an annual or biannual amount for a tax, or rephrase that. It's not the same thing as like licensing a car every couple of years or relicensing a car every year. In Oregon, for example, in Oregon, we have to renew our tags every couple of years, right? Do we pay a flat fee for the renewal, or is it based on the value of our vehicles?
Flat fee.
It's a flat fee. So if it's a flat fee, is it considered a personal property tax?
No.
No, it's not. So that's why we don't include it. But anyway, in this case, in Nebraska, it is. She paid $220. So these are all different taxes. General sales tax calculation. What's the first thing we do? When we go to the sales tax table, what's the first thing we look for in the sales tax table?
The state.
The state. That's right, the state. And then we also have to make sure we're getting into the correct percentage there, which it should be right. It should, when you go to the table for that year, this should already be correct, but you want to make sure. So you go to the state. Then you go to the amount of her income. What was her income? It's $37,259. So which line should we be in? Line 1, 2, 3, or 4?
3.
3. This line right here. Perfect. How many exemptions does she have?
1. I don't know.
2.
How many people is she claiming on her return?
Wasn't it 2 kids?
No.
That's okay. Let's go back and look at it. Oops.
Too far.
I went too far. Sorry.
Mark and Beverly.
Okay. 2 kids and herself. So how many exemptions does she have?
3.
3. So what is her general sales tax amount?
574.
Perfect. It's this line 3 intersecting with the 3 here, 574. So there's the 574. Now, how much did she say? She also gets to add in the personal property tax that she paid for the minivan. So she gets to add this amount in. So those two amounts added together is $27.74. Okay, so there's the amount of sales tax that she paid. How much personal income tax did she pay?
That was the
It's okay. Let's go. It's all right. How much personal income tax did she pay?
1863.
1863. How much? So I'm going to come back here. So they've written that down here for you. How much did she pay in general sales tax? And so on.
74.
2774. So which would be better for her to take?
2774.
2774. That's exactly right.
Okay.
So Schedule A taxes paid. We're continuing with this illustration. So Schedule A taxes paid deduction. So this is how we come up with her total deduction. Her general sales tax, we're taking that. Remember, which line does she report income taxes or sales tax on?
5A.
5A. So this goes on to 5A. Now she also paid real estate taxes of 1,025. What line does that go on?
5B.
Perfect. She also paid that personal property tax, $220 for and that was for the value of her van. What line?
5C.
When you add it all together, what's her total taxes that she can potentially take?
4019.
4,019. Now, what's the last step that she has to do before taking it?
1,000 and look at take the smaller.
That's right. Compare it to the cap. It cannot be more than the $10,000, but she compared it. So does she get to take the entire 4,019?
Yes.
Yeah.
Yes, she does. Okay. All right. So let's do some knowledge check. Skip's mother, Trudy, owes yearly real estate taxes of $2,500. She is the sole owner of her home. Trudy is not required to file a tax return because her income is too low. Skip helps his mother by paying her property taxes. He itemizes his deduction, which is true for Skip. So I want you to read through that and then type in your answer in the chat room, A, B, C, or D. And I want everyone to type in an answer for this.
Sorry, I cannot see.
Okay. Let me know when it comes up for you, okay?
Oh, yeah.
Everyone else go and get their answers in there. Okay, I got Garrett and Sheila's answer. I'm still waiting for everyone else's. And Noemi, are you able to see it now?
No, just go on. It's okay.
Okay. It's okay. I'll come back to you. Everyone else get your answer in there, please. Okay. So Noemi, I'm going to have you answer this verbally. So here's the situation. Skip paid his mom's real estate taxes during the year. Okay. He's not the owner of the property. He paid the real estate taxes during the year. Okay. Skip is itemizing his own deductions. Let me ask this differently. Can he deduct the real estate taxes that he paid for his mom?
No.
No, that's correct. So the answer in this case is actually D. Why is it D?
He doesn't own the house.
Right. Okay. So, not in his name. So, I want to slow down there for a second. Let's discuss this for just a minute. If somebody tries to pay real estate taxes for something not in his name or her name, are they ever going to be able to claim the real estate taxes?
No.
No.
No. It always must be in their name. So the first thing in real life and when even testing, anytime you see real estate taxes, if they say anything that, if they start giving you information about somebody paying for someone else or somebody owning something, stop and pay real close attention. There's a good chance that's what they're testing you on. Okay. So it doesn't matter who paid it. It matters who owns it. Okay. All right. Which of the following is not deductible for state or local income taxes on Shanta's Schedule A? So which of the following is not deductible as state and local income taxes? Local tax withheld, shown on her local income tax withheld, shown on her W-2. State income tax withheld, shown on her W-2. The balance due. In fact, you know what? I want to do this, and I'm doing this more for Noemi, who's just, it's not coming up for her as easily. So let's do this together, okay? Let's do this. On A, local income tax withheld, shown on her W-2. Is that includable on a Schedule A?
Yes.
Yes. Would everyone agree with that? Okay. How about state income tax withheld that's shown on a W-2G? Is that includable?
Yes.
Yeah. It doesn't matter. It's a W-2G. That's just from gambling. It's still income tax, and that's absolutely includable. How about balance due on her 2-year-old state return that she paid this year? So she just did it she did her return late is what happened, and she owed some money to the state of Oregon, let's say. Does she get to include that on her tax return, her Schedule A?
Well, she paid it this year. Yes.
Right, and that's what we're talking about is for this year's Schedule A. That's right. In the year she paid, it's still a state and local income tax. That's the point. Because she owed some money, it's still a state and local income tax. So yeah, you get to include that. Her last, and so the fourth one, her last state estimated tax payment for this tax year made in January of the following year.
No.
No. Why? You guys are right. This is almost a trick question, though. You guys all got that right. Why is that? Can somebody explain why she's not allowed to claim it?
She hasn't paid it for this year.
Right. She paid it. That's exactly right. She paid it in this year. So will she get to take it next year when she does her return?
Yes.
Yeah, absolutely. Perfect. Good job. Now, Velma pays taxes on the registration of her boat each year. The tax is based partially on the value of the boat and partially on the boat's length. So already, guys, stop for a second. Have we ever talked about something's length as being a deductible tax?
No.
No. Have we talked about the value of being taxed on the value of something as being deductible?
Yes.
Yes. So already we know what is, without even going to the rest of the question, what do we already know what we're aiming for here?
Value.
The value part of the boat. That's exactly right. So when Velma claims, length is not deductible. That's right, Garrett. When Velma claims a deduction for this personal property tax, how much is she able to deduct?
Solely on the value.
The value part.
That's right. The amount based solely on the value. Yeah, that's all. Let's do this partial problem. Molly lived in Washington, D.C. the entire year. She is taking exemptions for herself and her daughter. So it's important just to remember this info. So she has 2 exemptions. Her AGI is $50,000, and she did not receive any non-taxable income. Okay. Molly bought a new boat this year and has her receipt. The sales tax she paid is based on the general sales tax rate. She did not keep receipts or for any of her other purchases. Molly paid the following deductible taxes throughout the year. So she paid state and local income taxes, $2,800. She paid sales tax on her boat of $2,234. She paid real estate taxes of $1,100. She paid personal property taxes of $75. Okay. So let's take a look. What is her general sales tax amount for the general stuff using the chart there?
503.
503.
Okay, and how did you get at that?
Her income or her AGI and then her exemptions.
Okay, so AGI is $50,000 right here, and she has how many exemptions?
2.
2. So I'm trying to do it on the screen with just a pointer, or so you can see it. 50 to 60,000 with 2 exemptions, so 503. That's how you got it, right?
Mm-hmm.
So that's off of here. Now, what else do we add to that, if anything?
Sales tax on the boat.
Sales tax on the boat. Why do we get to add sales tax on the boat? Because this is still based on the general sales tax rate, as is this. This is for generic stuff. They let you, in the rules, they let you add in general sales tax on specific items as well. Of course, you have to keep your receipt if you're going to do this. So she paid this amount. What's the total amount she paid? $22.34 plus 503 gives us what?
$27.37.
Okay. So 2,800.
Yeah, 2,800 is higher. That's a higher deduction. That's
because I
state
didn't.
income tax was
You
higher.
know what? That's because I made a mistake and didn't finish the
Yeah, we need
That's
to
because I made a mistake. I forgot to do it. Or she paid. See, there's a mistake. I made it. I jumped right to that. I was so busy involved with that, I forgot to say, okay, it's either that or state and local income taxes, 2,800.
Mm-hmm.
So which is she going to take?
2,800.
Perfect. That's exactly right. If Molly chose to deduct the sales tax, what would that amount have been?
$27.37.
Which we already calculated.
Yeah.
Perfect. Okay. Well, that was nice. They gave us the answer. What's more advantageous? State and local income taxes. That's nice. We already knew that. And this is how you calculate it. But notice how we were able to do it even without the worksheet. Okay. All right. So guys, that's it for taxes. Taxes are only confusing to the extent that you just got to keep a few simple rules straight and you're good to go. So before we move into interest, I just want to know if you have any questions about this. No? Okay. So now we're going to go into interest. Home mortgage interest is the main thing we're talking about. Interest, points, water points, those are prepaid interest. It's just the amount you pay basically on a loan ahead of time as part of the loan. And anyway, and then there's qualified mortgage insurance premiums. What is, I want to, most people don't really understand what a mortgage insurance is. When you buy property, you're supposed to put down at least 20% cash down. So if you're buying $100,000 property, how much should you be putting down at a minimum?
30%.
Or 22,000.
Well, let me back up because I'm getting all sorts of answers and none of them.
James, the qualified mortgage interest insurance is no longer deductible.
Did they take that out? Sorry, guys. All right, so let's ignore that. My apology. I want to make sure among you guys, though, Garrett, you've been doing taxes this year. Was it taken out? I just want to double check that everyone agrees because I'm sorry, I did not.
The insurance premiums?
Yes.
Mortgage
I thought they
insurance
were
premium.
included this year.
No, they weren't.
Okay.
That was my recollection that for this last year we could still include it. Not everybody had mortgage insurance, and so but the ones that had it, I thought I know I did it.
Let me double check. Let me double check here, guys. I pulled out a book here. We're gonna do, and I apologize, guys. This is what makes things so difficult with these changes. So, give me just a moment. I'm looking.
Okay.
I went through this with several of my
That's a
clients.
pub.
No, I believe you. I believe you. I just want to make sure that I just did not remember that.
Mm-hmm.
5-12. I'm looking in a reference book that I have because I think this is important for us to get straight because you guys are going to be tested on it. Yep, it expired. Unless Congress renewed it, and I'm not, so unless they didn't. Okay, so she's right. So we're just not going to discuss this, okay?
Okay.
So interest and points is what home mortgage includes. Investment interest, we're not talking about that, okay? We're just not going to talk about that. Technically, there's some investment interest you could include, but it has its own set of rules. Personal interest is not deductible. What are we talking about? Interest that you're paying on car loans for your, for yourself. Interest you pay on taxes that you owe because you're having to make payments. Finance charges from credit cards, late payment charges by public utility. Those are all examples. In other words, personal interest you just don't get to deduct on a Schedule A. Home mortgage interest you do. Now, what does it take to have a home mortgage interest? It has to be, first of all, the taxpayer has to be legally liable for the loan, and they obtain the mortgage to secure the debt. Okay. In other words, there's collateral there. Okay. Charges that you do not include in interest that might be part of closing costs are like appraisal fees, notary fees, preparation costs, for the deed, funding fees if you're part of the Department of Veterans or using their assistance. The point is these are all costs of closing a deal. They're not part of the loan itself. They're not considered interest. Okay? And you only get to take it, this all depends on deductibility. This is what it says. Deductibility depends on the date you took out the mortgage amount, and how you used it. What we're saying is this. You had to have had the loan before the end of the year. You had to have paid some interest on the loan before the end of the year, and you had to have used the funds to buy the property. I'm looking at some other stuff here. Yeah. And then what type of debt can it be? A grandfather debt, in other words, a debt that you inherited or took on from someone else. A home acquisition debt is the most common kind. This is where you got the loan to acquire the property. You used it to acquire the property, or home equity debt where you did a debt for the home. You've got equity in the home, and then you use the funds to make improvements or something on your home. I don't want to go through this other than to point out there is this figure. It's a little chart to help you determine if interest is going to be fully deductible or not. We're not going to go through it. In real life, you may want to use that in some circumstances to help you work through all the questions. But let's talk about this now. What do we get to include? Points, fully deductible when paid at closing. Okay. You get to deduct all of this when paid at closing, or deductible over the life of the loan. When paid to purchase a second home, establish the home equity line of credit, or refinance. Okay. So, okay. Okay. That's fine. Noemi would just send a little note that she's having an internet problem and she'll be back. So points. Here's what I want you to know about points. They're prepaid interest. This isn't too bad, but what this is points normally are the second thing, deductible over the life of the loan. So if you have a 15-year loan, you deduct an equal amount each year over 15 years. If you have a 30-year loan, you deduct an equal amount over 30 years. Now, you have to, there is one exception basically to the fact you take it over the life of the loan, and that is when you're first purchasing a property. You can potentially do this first one. When you're first purchasing a property, it can be fully deductible when paid at closing. So if you paid $5,000 in points and you purchased the property in the first year, you can take all $5,000 as if that was all interest you paid in that year. Otherwise, let's say you already own the property and you're just establishing a home equity line of credit and you paid some points, you're going to have to take that over the life of the loan, whatever the loan life is. Okay? Or when you refi, and this is pretty common right now because people have refied over the last few years because the interest rates were lower. So they refinanced their homes. They paid points in that. Because it's a refi and not a new purchase, they have to deduct that not all at once, but over the life of the loan. Points. Any questions about points? It's actually, points themselves are confusing but simple. Just remember that. Just remember that what points are, prepaid interest, and that you normally deduct points over the life of the loan, except you can take it all at once when you are first purchasing property and paying points.
So in other words, it's like military intelligence. It's confusing but simple.
You're right. You're right. No, for real though, guys, this is not complicated. It's just weird because we're not, unless you're in the business, points don't make a lot of sense. In fact, to this day, points to me don't make a lot of sense. I think it's just another way for the banks to charge you more money, personally. That's
what it is, essentially, isn't it?
Yeah.
Based on your credit rate, it's why you have to pay points. So
yeah. So anyway, the point is, yick. Courtesy laugh there. The point is, the point is that think of points as you normally will pay it over the life of the loan, except you can choose to take it all at once if you're purchasing new property. If you, any other reason, take it over life of the loan. And notice this qualified mortgage insurance premiums, we already found out they're expired. This slide even tells me that. And as you can see, I haven't reviewed this slide since 2 weeks ago, so I had even forgotten this was on here, and this would have answered our question that Sheila brought up earlier. So points is all I want you to focus on there. So here's a mortgage interest statement, also called a Form 1098, mortgage interest statement. Normally, the amount of mortgage interest that you pay during the year, not normally, the amount of mortgage interest you pay during the year will be reported right there. Okay, and then there's other information about your mortgage that'll be here on these other boxes, but box 1 is the key. That's the amount that you get to take. If you have more than mortgage interest statements from more than one place, you add the amounts from box 1 from each mortgage interest statement, and you report it all on what line of your Schedule A?
8.
The 8 is correct. Specifically 8A or B? Just read 8A and B and you'll know which one. Anyone. It's 8A. Not just 8A. Because 8A says what, Garrett? Read that to us.
I just had it here. Just a second. I got to get that screen back up.
Sorry. It's okay.
8A is home mortgage interest and points if you don't use all your home mortgage loans to buy, build, or improve your home. See instructions and check this box.
And then A
says home mortgage interest and points reported to you on Form 1098.
So all we're saying is they are, and 8B is for home mortgage interest not reported on Form 1098. They're just making a distinction there. 8A is where you report home mortgage interest that's reported on this form here. That's all. Okay?
Yep.
Oh, in fact, that's what we were getting into here. 8A is the deductible home mortgage interest and points that are reported to the taxpayer. Um, 8B is you enter home mortgage interest that was not reported to you on a Form 1098. Now, usually this includes interest paid on seller finance mortgages and the taxpayer share of interest that was reported to another individual. In other words, let's say I own a house and I sell it. I'm sorry, that came out wrong. I sell it to Sheila, just to use an example. So let's say I own a house and I sell it to Sheila. And it can't cash me out 100%. So I agree just to do my own loan where she's going to pay me interest and principal every month, very similar to what she would with a bank. Well, I have to, in that case, send her a Form 1098 for the amount of interest that she paid me during the year. Or I might not send it to her. If it's under a certain amount, I might not have to. Point is if it's not on a Form 1098, and in that example, she would have to put on her tax return the amount of interest she paid me. So let's say I did not send her a 1098, she would report that interest on line 8B. Does that make sense? My example might have been confusing, but does the rule make sense?
It makes sense.
The rule makes sense.
Okay.
I had people who had like a bank statement showing the amount of mortgage interest they paid, but it wasn't actually a 1098 form.
Well, no. When might you do that? Well, they haven't put this in here, but again, I didn't make these slides. I'm just sort of trying to use them. Interest. What else can you claim? Well, maybe they'll get into it. I can't remember, guys. It's been a couple weeks since I've gone through these slides. But when you're claiming something, what can you claim? You can claim interest on your first home and second home. Not just your first home, but you can claim first home and second home. What might be included as a second home on your return?
Vacation home.
A vacation home. So maybe you got a vacation home down at the coast. You get to include your interest, mortgage interest you pay not only where you're living in your main home, but your second home. But what if you don't have a physical home located on a physical property? Maybe all you have is a fifth wheel. Can you claim that as a second home if you take trips in it and live in it part of the time? Yes, you can.
Yes.
Okay.
Sorry, I was muted.
That's okay. I'm giving everyone a chance that might be new to that, might have thought, no, that's not a home. Well, anything you live in that can be potentially lived in and that you do in fact use during the year could be a second home. Are you ever, but when you buy something like a fifth wheel, are you ever going to get a mortgage for that fifth wheel? No. But are you very likely you might get a loan for the fifth wheel?
Yep.
So you're not going to get a 1098. You're going to get a loan statement from the company that's giving you the loan, very similar to a car loan. And it's going to tell you how much interest you paid during the year. If you had a fifth wheel and you had to report that, this is the line, the interest you'd report it on for your second home. That's where you'd report it. Line 8C is for points that you can deduct that's not on a 1098. And that might, or, again, you might have done a refi that might not show up a 1098. There's other circumstances where you might have points that don't show up on a 1098. If it shows up on a 1098, it goes on line 8A. If it's not on a 1098, interest on line B, points on line C. Line 8D has expired. Okay. And then I want everybody to grab their Schedule A for a second. Okay, so line 9 says what?
Investment interest.
Investment interest. What do you think investment interest means?
Interest on things like stocks and bonds.
Well, wait a minute. What do you mean by that? By interest on stocks and bonds? Because we're not talking about income here. We're talking about expenses that you paid. You paid interest.
Oh, interest you paid. Okay.
Right. It's okay. This is why in the course we're not really covering it, but I just want to touch on it so you know what it is.
Investment property.
Give me an example, because investment property can be any number of things.
Okay, real property that you have invested in.
You might. You can. It just depends on what we're talking about. But let's say you did invest in property that you're not using. If you're not using it as a rental, then yes, you would be right. So let's say we bought a piece of property that we know is going to go up in value and we're just holding on to it for 20 years. So yes, but you had to get a loan to get that property. There would be an example. You're paying interest on it. Let me give you another example. You know, there's a great deal on buying a brand new IPO, or initial public offering, which just means a new stock coming onto the stock market, and you want in on the ground floor. You believe that you're going to make a lot of money on it, so you might go get a loan, just a loan of say $1,000 to invest, and because you believe the interest that you pay on that loan is going to be less than the amount of money you'll make from buying the stock. Well, the interest you pay on that loan is a deductible interest on that line. And to let you know, that's the most common example. I think any investment, like was said, could potentially be included there. But think, for purposes of learning and passing the exam, think in terms of if you got a loan to make an investment. That's as far as you really need to go with it. Got a loan to make an investment, say to buy stock. The reason is anytime you start thinking about loans for real estate, now we're starting to get a little bit into a weird area that it might not fit into that category, but fit in some other category. So, is that good enough explanation there? Or does somebody kind of still a little bit fuzzy on that?
I understand.
You good with that, Tina? With that one?
Yeah, I'm good with it. I just had it printed out of Schedule A.
Okay, no problem. And it does help to have it in front of you. That's what I'm looking at. So
Okay.
investment interest just means, for whatever reason, you've invested in something and you're paying interest because of your investment. This is what you're paying. And if it's for an investment, you're going to be able to deduct it. And it can be for anything that's an investment. Okay. And then on line 10, you just add all the amounts together. Okay, that's claiming interest. So here's a mortgage interest statement, and we're just going to look at one that's kind of filled out. There's the mortgage interest received. Okay, $5,243. This is giving the amount of mortgage principal $0. That's not very realistic. Really, you got it paid off? That's awesome. More, because what that's supposed to be is how much principal still exists at the end of the year. The mortgage origination date, that's important, so you know where you're at in the mortgage. Mortgage insurance premiums, that would be non-existent now. Points paid on the purchase of principal residence. So how much will this person get to claim on their income tax return as interest?
$6,253.
That's right. And how did we get that? We got it from, obviously, box 1, we get to include that, but these are points that were actually paid to purchase the principal residence. This person can choose to take it all at once or take it over the life of the loan. If this had been a refinance, could he have taken this all at once if he had just refinanced? Yes or no?
No, he has to spread it over the life of the loan, doesn't
No. No, that's correct.
No,
He could
just
not
on
have.
initial purchase.
Yeah, that's exactly right. You guys got that. Okay, so let's do some practice here. Asa did not qualify for a mortgage, so his mother, Sue, bought the house next to hers. She took out a mortgage for Asa, who lives there with his girlfriend. Asa and Sue have a verbal agreement that he pays the mortgage payment each month directly to the bank. So what the question is which is true regarding the interest on the mortgage. So let's go through this one together. Asa can deduct the interest, but Sue cannot. Is that true or not true?
No.
No.
Okay. Why is it not true? What makes it not true?
It's Sue's mortgage.
It's Sue's mortgage.
It's Sue's mortgage. So Asa can or cannot
Sue
deduct
bought
the
the house.
interest.
Sue bought the house, so yeah, the mortgage is in her name. So
That's exactly right. So Asa cannot. Sue can deduct the interest, but Asa cannot.
That's true.
True.
Okay, let's come back to that one. Asa and Sue can each deduct half the interest.
No.
Neither Asa nor Sue can deduct the interest.
No.
Hold on just a second. I'm looking at something. Now, I'm going to give you the answer, and then I want you to backwards reason what you know. Neither Asa nor Sue can deduct the interest. Why do you think that is? Just give a shot in the dark. It's okay if you're wrong. This is how we learn. But give.
she's not living in the house.
Oh,
No, not living. Well, I mean,
No,
yeah,
that
but that's
doesn't
not
apply.
the. I mean, that's true, but that's not really the underlying reason. You're closer though.
She doesn't actually pay the mortgage.
There you go. Asa, Asa doesn't. Why can Asa not get to take this? Why does Asa not qualify to take the deduction?
Because it's in his mother's name.
That's right. It's in his mother's name. It has nothing to do with him. It's similar to the whole thing about the real estate taxes, why you can't take it. So
But if
Asa,
they put it in both their names, even though she took out the mortgage, he could claim it then, couldn't he?
yes.
Yeah.
But here's the problem. But here's the problem in this example. Back to just this example. Why isn't Sue not able to deduct the interest?
I don't get that part.
I don't
So
get it.
doesn't make the payment to the bank.
Because she didn't make the payments. You only get to deduct what you actually paid.
Oh,
She didn't make the payments.
got it.
So that's the key. When you get to deduct what you actually pay, but if you pay it, your name had better be on it. Otherwise, you don't get to deduct that.
Mm-hmm.
That makes sense now?
Yep.
Yes, it does. Thank you.
Okay, so Patricia,
We have an agreement.
Learn something there.
could I think I heard Noemi, or I think it was Noemi, say something, and I.
Yes, because that is their agreement that he pays the mortgage.
Yeah, that's their agreement,
Month.
but their agreement doesn't change the tax law.
Okay.
He can pay it all day long, but he doesn't get the credit for it.
But
And
if he paid her the money and she paid the mortgage after he gave her the money,
Then she could
paid it out of
probably.
her account, she could claim it.
yes,
Technically, yes.
yes, they'd have to be very careful about what they're doing there because they may be running into gift problems depending on how much she was giving her every month. He could gift it to her. But if you got over your annual amount, which we really haven't talked about,
14,000.
yeah, I think it's 15,000 now, but I may be wrong about that. But anyway, the point is we haven't really gotten into discussing that. But the point is, though, is they'd have to be careful because there could be tax consequences for her in that situation. Could be. I'm not saying there would be. If they structured it right, they'd be fine. But that's as deep as I want to get into it because that's not the point. Patricia owns her home and has no mortgage. Okay, so she owns it outright, not making mortgage payments. She paid for new siding for her home with her credit card. The interest for the siding on Patricia's credit card.
Non-deductible interest.
Non-deductible, right? No.
Okay, I've heard. I just want everybody to pipe in before I show you the answer. So it is deductible interest as a home acquisition debt, deductible interest as a home equity debt, deductible interest as a personal debt, or not deductible. So I've heard two people already answer not deductible or non-deductible interest.
Yeah, I agree with that.
Okay. You guys are right. You guys are right. Now, let's change this slightly. What if she had gone and gotten a line of credit against her home and then used it to improve her home and paid interest on the line of credit? Could she have deducted it?
Yes.
Yes.
And which way could she have deducted it? As home acquisition debt, home equity debt, or personal debt?
Home equity debt.
Home equity debt. Home equity debt. Home acquisition debt is when you buy the house for the first time. And can you ever deduct personal debt interest? No. Perfect. Wyatt bought a house this year and received the Form 1098 here. His AGI is $66,985. What is the total of all deductible items?
Well, 5534.89.
Yep.
5534.
Yeah, and why is that answer wrong?
Oh, because of the 407. I wasn't looking at that.
No. This answer is not correct because they're adding
mortgage insurance premiums in. And
Yeah.
they're adding that in. I don't see anything else. 66.
No, there's nothing else.
Yeah, see, this is completely wrong. And so, guys, ignore that. The correct answer is the amount in box 1 only because mortgage insurance premiums don't count.
Yeah, I looked that up in the Pub 17 while we're doing this, and
Yeah.
there's a note right there.
Yeah.
Pub 17 that says it expired the 31st of December.
Yeah, that's what I was checking up too. And I think I did read that. I just honestly had forgotten.
Yeah, I checked that out when I ran into it with my clients.
Equals
Only reason why I knew.
That doesn't add up to that number, though.
Yeah, I know why. I know why, though. But why doesn't it add up?
So I'm trying to figure out. There's something else. Oh, real estate tax.
There you go. Real estate taxes. That's
I
all.
didn't see that.
That's all. There's real estate taxes down there.
That gets us to
Yeah.
that number.
I know. I was doing the math too while you were saying that. So it's this. So this. What is the correct answer then? Let's do this together. The correct answer is the amounts in box 1 and box
11.
11.
That's right.
535 plus 8.
6388.
388.
Yeah.
That's right. 6388. You're 100% correct. Okay, and I'm going to make a note to correct that later. So everyone that's watching this after the fact, sorry, we found an error. 6388. And I'm making a note here so I know what
Probably a
slide.
2017 slide.
No.
It is. It is. These are all from last year's basic course. So guys, that's it for interest. Now we're going to talk about charity. Okay? Which lines, look at lines 11 through 14 on the Schedule A. So everybody pick up their Schedule A again, look at lines 11 through 14. Line 11 is for reporting what?
Gifts by
cash check.
or check.
That's right, gifts by cash or check. In other words, even a check is considered cash, or even credit card or payroll deductions. That's what you see up on the screen.
Meaning money is given.
Money, actual money, that's right. But what is line 12 for?
Items we donate.
Yeah, the actual words here are other than by cash or check, but what we're talking about are things like we think of when we think of Goodwill donations. Those are non-cash items, okay? And then, what's the next line for? Line 13.
Carryover.
Yeah, if for some reason you were not allowed to take, let's say last year you had a bunch of deductions, but for some reason you couldn't take them all, you could have carried them over to this year. So that's what that is for. So all you do is you figure out what you can take on each of the lines 11 through 13, you add it all together and put it on 14. Okay, so what kinds of things are deductible as charitable contributions? Well, money that you give to churches and the like. You don't have to memorize all of this. Just think of churches, synagogues, temples. They're all kind of the same thing. So any money you give to a church or the like, any money you give to a government, and it doesn't matter if it's federal, state, or local, if it's for public purposes, in other words, for a public benefit. Money you give to nonprofit schools or hospitals. Key here is it has to be nonprofit. Any money you give to what we think of as actual charities, Salvation Army, American Red Cross, Goodwill, and so on. War veterans groups. So those are all just examples of money you give to them. Expenses paid for a student living with you. Look, that just doesn't happen. They're talking about like, you've got a student maybe from another place, or through a qualifying organization that is a charitable organization, and maybe you got a student living with you and you're paying out of your own pocket for the student, those are actually going to be potentially charitable deductions. I don't want you really to remember that, because I don't think you'll ever get tested on that. In fact, I've never ever in 15 years of doing taxes seen this example. Out-of-pocket expenses when you serve as a volunteer for a charitable organization. So you're working for your church and you're paying some out-of-pocket expenses to, maybe, let's say you're a youth group leader and you're, paying to get the kids to the youth group on Wednesday evening, and you're paying some money for them to have stuff when they're at the group. Those are includable. If you are a scout leader and scout leaders have to buy their own uniforms, you would get to deduct that. That's an out-of-pocket expense while you're serving as a volunteer. Those are examples of what you can include. What can you not include? You cannot include money given to sports clubs or labor unions, because they're not considered charitable organizations. That's not to say they don't do things that are charitable, but we're saying they're not classified with the IRS as a charity. They have to actually be classified as a charity with the IRS. Foreign organizations, there are some exceptions. Basically, the Canadian and Mexican and Israeli charities. Groups that run for personal profit, obviously, that's not a charity. Groups whose purpose it is to lobby for law changes. So what are we talking about there? We're talking about political organizations. Political organizations, you donate to the Republicans, or you donate to the Democrats, or you donate to, whatever you donate to. If it's got a political purpose, it's not deductible. Homeowners associations, those are not deductible. Political candidates, gifts to political candidates, that's not deductible. Okay, you also don't get a deduct when you buy bingo tickets or lottery tickets, even if you're, and we're not talking lottery with the state, we're talking about you go into like a Catholic diocese and you're playing bingo, you have to pay maybe like $30 to get in. You don't get to deduct that because you're getting a value back out of it, that's why. So that's not considered a deduction. Dues that you pay to country clubs, those are clubs you're involved in, those are not nonprofit. You don't get a tuition, even if you're giving money to somebody for tuition, it's not deductible on your taxes. Your time, Girl Scout cookies, no. Why? No, it's a great question, but why is that? You know the answer now.
Because you're getting something for it.
You're getting something for it. You're effectively buying something for yourself. Now, if you walked up to the Girl Scouts and handed them $20, would that be deductible?
Yes.
But if you turn around, in fact, let's go here. I think it's going there, but let's go here right now. Let's say you go up and give Girl Scouts $20. Is that deductible as a charitable contribution?
Yes.
Yes. If you go and buy cookies for $20 from the Girl Scouts, is that deductible?
No.
No. Now, what do you say you go up to the Girl Scouts and they say, hey, I got cookies here. These cookies are worth $20. That's what we're going to charge you. Will you give it to us? If you give them 20, we've already determined that that's not deductible. But what if you decide to give them 30 instead and tell them to keep the change?
The $10 would be deductible.
Okay, I think you all said the same thing, but y'all talked at the same time. So, one of you choose. How much of it, first of all, is some of it deductible? In fact, let me direct this. Tina, don't want to put you on the spot, but I kind of want you to interact with this. Is part of that in that example going to be deductible?
Yes.
Yes, it is. How much?
$10.
The $10. Why? Because you got $20 value back.
Yes.
So, I do a donation to go, let me think about a good example. I do a donation to go to, I don't know, I'm going to say a church dinner. They're just using this to raise money. So I do a $100 plate, so I buy a dinner for $100 and I go in there and do the dinner for $100. Now, obviously, you know, the what they fed me is not actually worth $100. It's only worth 30. Am I going to be able to, because I did a donation and then got a dinner as part of it, and am I going to be able to deduct all of it as a donation?
I don't think so.
No, you're not. But you're going to be able to deduct some of it. How much can you not deduct in that example?
Value that you received back.
That's right. And so in that example, the value I received back is
$30.
30.
Right. And the remainder, the remaining $70, I get to deduct. Does that make sense?
Mm-hmm.
Okay, that's the point. It's an important point. Another thing that you cannot deduct is the value of your time or services. So I may be working for a church, and I might be, you know, doing some volunteer work for my church, and let's say I've got the skills to do plumbing for the church, because maybe I'm a plumber. And so I buy all the plumbing stuff to plumb a new restroom in the church for them, so we have more restroom space. So I plumb it, I buy all the parts, and I do the plumbing. I spent $100 on plumbing pieces, like the actual pipes and everything. And let's say I would normally charge $50 an hour, because I don't know what my time is actually worth, because I know they charge more than that. But let's say I would normally charge $50 an hour, and it took me 4 hours. So I would normally, if I had been hired, charge them $200 plus $100 for the pipes. What can I actually deduct out of that?
$100.
$100 for my actual out-of-pocket expense. I don't get to count my time, the value of my time. Okay. We kind of got a good idea on what's includable, what's not. I think so. Okay. We've already gone over that. Contributions of property now. So non-cash contributions like Goodwill donations. This is usually for clothing and household goods. It's got to be in good condition or better. Okay. And examples: furniture, electronics, appliances, linen. The fair market value is what you get to take. The fair market value is the price that you would actually pay in a used clothing store, such as a consignment shop or thrift shop. Okay. So when you're donating, it has to be in at least good condition, and that's important because it used to be that poor condition was deductible, and they got rid of that several years ago now. But you take the fair market value. How do you determine the fair market value? You can determine any number of ways. Basically, what you do is you consider, hey, what would I buy this for in a thrift shop? What would I actually pay for it in this thrift shop that I'm donating to? That's the easiest way. So James donated a coat in good condition to a thrift store operated by his church. He paid $300 3 years ago. Similar coats in the thrift store sell for $50. Therefore, the fair market value of the coat is $50, and that's also his contribution amount. He also donated some used athletic shoes in poor condition. He can't take a deduction for those. Cars, boats, and airplanes. Big ticket items like this, they have to donate it, and there's very specific rules. It has to be donated, and the organization has to send them a 1098-C for contribution. 1098-C. Look, I don't want to get into this a whole lot. I want you to read it. I don't want to get into it in our presentation, I mean a whole lot. What I do want you to do is read through this information just so you know it. But no, big ticket items, the reason is these are such big ticket items, these are worth several thousands of dollars. The IRS is not going to let you easily take this deduction without a significant paper trail, which includes this here from the organization that received it. And the organization has to report all information about it, including what they sold it for, which is also going to be the amount that you get a claim. But they'll know it because it'll be reported on here. The gross proceeds from the sale. See that? Mm-hmm. And if in fact they choose to keep it, maybe you donated a car and they decide, or a van, they decided, hey, we need this. They've got to put it in there as if they're going to give it a value. and they'll report it that way to you. You only get a claim expenses that come out of your own pocket for which you're not reimbursed. Okay. That are directly connected with any services you provide. Like, for instance, a Boy Scout leader has to be directly related to the Boy Scout volunteer work you're doing. It's not for personal or living expenses. You can claim vehicle expenses. They must be directly related to the use of the vehicle for the charitable purpose. The actual expense rate is, I think that's wrong. Pretty sure it's 16 cents a mile. I can tell you here in a second. I got the cheat sheet here. Thought I had the cheat sheet here. Oh, there it is. No, it is. My bad. It is 14 cents a mile. This is 2018 amount. So I did correct that. So it is 14 cents a mile. So that is the amount for vehicle expenses. And then you can always include parking fees and tolls while you're doing volunteer work. So just for a moment, let's digress, because now we've gone through everything that we need to discuss. What is the standard for 2018 amounts we're talking here? What is the standard mileage rate for business related expenses when you're using your car for business? What is the standard mileage rate?
54.5 cents.
What about for medical?
0.18 per mile.
18 cents.
18 cents a mile.
Yeah,
And then for charity, or
14 cents.
14 cents. So just remember those three amounts that will help you in not only in real life, but it'll also help you while you're trying to take a test, because then you won't have to be trying to figure that out. Okay, so 54.5 cents for business, 18 cents for medical, 14 cents for charity. Right. Hey, when you're traveling means you're going away from home while performing services for a charitable organization. You can claim travel expenses. You cannot include anything that is, if you're away mostly for personal pleasure and recreation, you don't get included at all. If you're going there and you happen to have a little pleasure and all that, that's okay. Just separate the amount of pleasure expenses from what you're doing for the charitable organization. And when you are traveling, you get to deduct your transportation expenses like airplane fee, train, bus, whatever. Your out-of-pocket expenses if you use your own vehicle. Your any taxi fares or anything like that, lodging costs while you're there, cost of meals while you're there. You can include all those things. I'm going to go right past that example because I think it's pretty commonsensical. Non-deductible contributions, these are not qualifying organizations, and we kind of touched on them. Civic leagues, groups that are run for personal profit, groups that are political based, homeowners associations. Be ready with homeowners associations, legal ones, ones that are running for political, just beware. I've seen those questions pop up as a test type question somehow. Like they might say, here are some expenses and this is the amount that they donated, and they might throw in there, paid, $500 homeowners association fees during the year. You would not include that in the group. Okay. So some of this is repeating stuff we've already been over. That's why I'm skipping right over it. Now, contributions that benefit the taxpayer. This is exactly what we were talking about earlier. If I buy cookies and I give $30, but I'm really only buying $20 worth of cookies, I can take the other $10. Another example, Margaret responded to a call from a tax-exempt organization. She would receive a book if her contribution was equal to or greater than $25. She gave $50 to the organization. The cost of the book is $15. So how much does she get to take as a contribution?
35.
$35. The $50 that she contributed minus the value that she received. That's all this is saying. We already talked about that. So Herman donated a desk that's in good condition. From the classified ads for the desk, Herman determined the fair market value to be $100. He paid $500 for the desk 7 years ago. What is the amount he gets to take as a charitable contribution?
$100.
$100, the fair market value. Cindy's favorite public television station, which is a charitable, which qualifies for a charitable contribution, had a fundraising telethon. The station offered concert tickets for a donation of $200. Cindy donated $200 and received the concert tickets. The acknowledgement she received stated the value of the tickets was $50. So how much can she deduct as a contribution?
$150.
$150, exactly right. The $200 minus what the tickets are worth. Robin worked for 4 hours as an unpaid nurse volunteering for a qualifying charitable organization. Normally she gets paid $30 an hour. What is the amount she can deduct for her time?
$0.
$0. You don't get a deduct for time. Karen drove her vehicle 466 miles to school and church events in which she donated her time. She kept a log of all her trips. How much can Karen deduct as a charitable contribution? Noemi, if you answered, I didn't hear you. I heard something.
65.
65.
Exactly right, 65. That's 466 miles times 14 cents a
14
mile.
cents.
Yep, perfect. All right, when you give donations, you've got to keep a record. They're getting more and more strict on this every year. Even if you give small amounts and you want to claim it, you've got to keep some kind of record. The more that you're claiming on your tax return, the more you and better records you have to keep. Let's see here. It's good enough. Cash contributions. This is what I want to focus on. For cash contributions, if it's less than $250, a bank record or a written record from the charity. Okay? If it's more than $250, you must have a written record from the charity. So cash contributions. So again, we want to make a distinction between cash and non-cash contributions. So cash contributions under $250, you have to have your bank record or a written record from the charity. And it has to have the name, date, and amount on it. If it's more than $250, you must have a written statement from the charity. Payroll deductions are almost an exception because the pay stubs will have the amounts on them and the IRS will accept that. Regardless of the amount, it won't matter. So if you're doing it as a payroll deduction, then it'll be on your pay stubs. What
IRS
about...
doesn't get all your pay stubs, though. You have to include the pay stub, right?
Would you say that again? I'm sorry.
The IRS doesn't have all your pay stubs, so you have to include a copy of the pay stub that has that deduction, don't you?
No, you're right. They don't have a copy of it. You don't include it any more than if I gave $500 worth of donations to my church, let's say, and they gave me a written record from that. I don't send that in with my IRS, with my tax return to the IRS, do I? No, you keep the record with your tax return, and if the IRS asks you to prove it, then you've got it.
Okay.
That's what you do. So payrolls, this pay stubs, no, they don't have copies of it. You just keep copies of it with your return just in case the IRS asks you to prove it. That's all. Yeah. So out-of-pocket expenses, we're talking about like while you're volunteering work for the a charity. So again, you got to keep a written record from the charity. The charity needs to give you something saying, hey, you know, like at the end of the year, thank you for volunteering throughout the year as a scout leader, for example. That you need to get something from them that verifies that you were actually doing this. And if you use your vehicle, you need to keep a mileage log. It doesn't have to be a mileage log, but it has to be some kind of written record of expenses. And it's got to have in there the dates that you were using it for the charity and which charity you using it for. This is no different than the requirements when you're self-employed and you're using your vehicle. You've got to have a written record and put down the dates and the miles and all of that. You've just got to put down it's what charity it's for and what you were doing, the date and the mileage. So you got to have some kind of written record for if you're going to use vehicles use as part of out-of-pocket expenses. Let's talk about non-cash contributions. These are a little more confusing because non-cash contributions can get quite expensive. So how do they divide it up? Just like cash contributions, it's less than $250 or more than $250, but there's a little bit more to it. Less than $250 for non-cash contributions like Goodwill donations. If it's less than $250, a receipt or some kind of written record from the charity. Okay, so when you drop stuff off at Goodwill, they hand you a little Goodwill card, right? It's up to you to actually write down a description of what's on there and how it's valued and the condition. It's up to you to do that. They're supposed to have their name, date, and location on it. And so the name, Goodwill's on it. They're supposed to write the date on it. The location you might have to put on there because there's many different locations. But if it's under $250, that card will suffice. Now, if it's more than $250, you have to have a written record from the charity with more information. If any good or services given and their value. Okay, so really what we're saying is if it's under $250, a simple receipt is good enough. If it's more than $250, you have to have it, but a little bit more information. So if you're giving something, let's say you just gave away a bag of clothes and it's worth $100. Just get the card, write down bag of clothes, put down, make sure the date's on there, make sure the location where you donate it's on there, put down a description of what you donated, one bag of clothes, how you valued it, thrift shop value, and then the condition, it's in good condition. And then you put down what it's worth, worth $100. Okay. Now let's say I give a whole truckload of stuff to Goodwill and it's actually, I value it at $450. You still get that card, but you should start breaking it down with more information. One bag of clothes worth $100. One couch worth $75. One desk worth $100. So you're starting to give more information. And then if you're giving a Goodwill type donation that's more than $500, it's the same thing as this one down here. Plus, you have to start reporting on your tax return. You have to do some special reporting requirements on your tax return stating when did you acquire it, how did you acquire it? In other words, what date did you buy it? How did you acquire it? Did you purchase it? Was it given to you? Whatever. The cost or adjusted basis you have in that item. And then if you have an auto or something like that that you donated, you have to have that Form 1098-C. And this is kind of important to know because you could be questioned on that. If you have something that's worth, if you've donated more than $500, they might ask you, what do you have to report to the IRS? If it's more than $500, you have to give them more detailed information about how you got the items to start with. Any questions about this? I mean, it's not really that bad, and that's why I like this screen. The screen's a little easier just to put it all together for you. No? Everyone feel confident? Tina, feel good about this?
Yeah, I do actually.
Noemi?
Yes.
Okay. Sheila and Garrett?
Oh, fine.
Okay. All right, we'll move on then. I am not going to go through this. I don't think we need to belabor this illustration. Did want to show you a 1098-C. This is a contribution. They donated Encore. Okay, so this is a car that was donated. They sold it for $897. So what does Greta, who's the donor, when she does her tax return, how much can she take as a charitable contribution for this?
$897.
$897. That's right. When you're doing non-cash charitable contributions, you do this form, the 8283. Do not memorize the number again. Just remember there is a charitable, non-cash charitable contributions form you got to fill out where you itemize everything. You put it down here. Remember we said you got to put down where you got the item. So there's the address. If it's a vehicle, you got to specifically mark this box like this one was. You got to put down a description of it. You got to put down when you made the contribution, when you acquired it, when you sold it, things like that. This is required when. This kind of detail is required when?
When it's over $500.
When it's over $500. That's exactly right. Okay. Okay, let's do this one together. Sally and Owen are MFJ. They gave $100 to a college and they got a magazine subscription for $88. They did volunteer tutoring, 140 miles times 14 cents, so $20 there. And they donated good in good condition clothing, fair market value of $80. So gifts by cash or check.
No, that's to a college though.
Is that a
Yeah,
charitable
it should have been a nonprofit. They should have put nonprofit in here. A college can be if it's a nonprofit college.
Okay.
So it absolutely can be. Keep in mind, it's just got to be considered a not-for-profit college. So a community college, is that considered a nonprofit or profit?
Profit. I don't know.
Profit.
profit, I would think?
Nope, it's nonprofit. You can donate to a community college. Community colleges are ran actually basically by the state. They're nonprofit. So you can give to that in certain situations. So here's what's important. I received $88. Okay, so I read this wrong when I read it to you. $100 to college minus subscription received. So that left at $88. So we do get to include this. What else do we get to include?
$20 for mileage.
$20 for mileage, so $108. Yeah. And what non-cash items amount do we get to include?
The mileage.
Sorry, say that again.
Mileage.
Well, yeah, that was already added in with this.
Oh.
You're actually right because it could have been down here. I mean, but what we were talking about is donating of clothing.
Non-cash.
Okay.
Yeah, that's
Okay.
what I was referring to. You're not wrong. It's just the way we did it was a little different. So $80. So we get to take the $88. We get to take the $20, and we get to take the $80, which totals $188. Okay, so Hamilton made a cash contribution of $30. Which record is he required to keep for this charitable contribution?
A.
Bank record.
Say B, canceled check or account statement.
Yeah, you want a canceled check and or account statement. Remember, that's a basic requirement for a cash donation. You got to have some type of account statement or receipt from the organization. If it's under how much will this suffice?
$250.
$250. That's right. Misty had expenses directly related to the use of her vehicle while providing services to a qualified organization. She wants to use the standard mileage rate. Which record is she required to keep for this charitable contribution?
The last one.
Last one.
B.
This is, did you say D? I can't hear what in it.
E is
Yeah.
dog, yeah.
Yeah, okay, sorry. Records showing the miles driven for the charitable purpose in the organization's name. In other words, a mileage log. That's what you need. Max made a charitable contribution by payroll deduction. He had it taken out as payroll. His employer deducted $300 from a single paycheck. In addition to his pay stub or W-2, which record is Max required to keep for this charitable contribution?
Account statement, canceled check, or receipt from the organization. Well, I guess is what I choose.
Well, but you're not going to have a canceled check, are you, if it's from a payroll deduction?
That's the only one that seems to fit. Account statement, it's like your pay stub, right?
I'll give you the answer. I get your reasoning. Look, all they're trying to point out is even from a payroll deduction, you still need something stating about the pledge or the
Yeah.
the key here is acknowledgement. Normally when you
Okay.
make it, you know, that they'll acknowledge, hey, you just gave us $300. You need something from the organization in writing about the donation.
Receipt from the charitable organization.
Yeah, let me tell you why they want that. They want that to match up with the payroll deduction to make sure it's for real. That's all. Okay. Esther donated a car to a qualified charity that she estimated was worth $3,000. The charity sold it for $1,300. What does she actually get to take? First of all,
$1,300.
yeah. It's really, and the charity must report to Esther the amount it realized from the sale of her car, which is
$1,300.
That's why I asked it the way I did. Mine was easier. Casualty and theft losses. Now, have we said we're not going to cover this?
Right.
Right. We're not going to cover this. So it's in here from 2017. What I do want to point out under casualty and theft losses is this point right here. For and by the way, I just remembered back when I prepped these a couple of months ago, all of these slides, and then I reviewed them a couple of weeks ago. I made this. So for many years, casualty and theft losses could be taken on personal property. However, the TCJA, that's the new tax law, changed that. Now casualty and theft losses cannot be deducted unless attributable to a federally declared disaster area. As a result, I'm not going to go over calculating the loss. Technically, there is still a calculation. Like Garrett, I think you were the one that pointed out there's still, the rules are still in place, but it's limited only to federally declared disaster area now, right?
Mhm.
Yeah, and it said was the $100 and the 10% AGI rule, but
Right.
federal disaster area, it's not the $100 rule, it's a $500 rule, and there's no 10% thing. So
right. So I do want to say one thing about this, and I'm only giving this to you in case they were to get into it and say, well, they have a loss from a federally declared disaster area. Here's the basic rule, and this is all I kind of really want you to remember about calculating it in case they ask you. Truthfully, you would probably not get the calculation right with only this information. But if you can even plug away in your memory just this amount of information. From each loss, you always have to deduct, I think it's $500 now, right, Garrett?
yeah, it's $500 for federal disaster areas.
Okay, for $500. So from each individual loss that you have, you might have a loss of a home and a loss of a car. Those are two from the same disaster, but you have two different losses, or rephrase that. You have two different losses from even different things, but each loss you still have to deduct $500, okay, from each loss. Then on top of it, you have to deduct 10% of your AGI, which works as you calculate it the same way you did with the medical deduction.
Not on federal disaster area. You don't have that rule for federal declared disaster. That's what it said in 2017.
Did they? I thought they kept that for the federal. They got rid of the 10% rule?
They got rid of the 10% rule, but upped the amount from the $100 rule to $500 rule. But you
Okay.
don't have the 10%.
Okay, my bad. See, guys, even I'm not up on it, and you're just not going to. We realistically are not going to run into this. So you have to deduct $500 from your loss in a federally declared disaster area. That's all I want you to remember now, based on our discussion. My apology for not being up on this. This is just not something that I run into much. And while I did my normal tax update, I didn't remember all.
And that was covered in the reading under Unit 13 is where I got that information from the EA course that we're doing with you. So
yeah. So you know what else too? If you guys go and get that program like we asked you to get, you're going to have unlimited access to the question bank. And I forget, was it Sheila? Was it you that pointed out to me that you could get for $40, you could get access to everything, including the updated book?
I think that was Noemi.
Was that Noemi?
No, no, not me.
I
I think
can't
it was
remember.
Linda.
Somebody pointed that out to me
Yeah.
that if you go a little more expensive each
Linda?
month, and I think if I were you, even if it's $40 a month, I think I would do it. I think it'd be worth it.
I'm gonna sign up for it next month.
Yeah,
Coming
yeah.
up. So just
I got you. So anyway, I just don't think you're going to get questioned on this, except maybe to see if about the federal be tested on a federally declared disaster area. If you do, and if they go any more detail, just remember there's a $500 deductible off of your loss before you get to take anything. Okay, that's all we're going to get into on this. Other miscellaneous deductions. Historically, miscellaneous itemized deductions have been divided into two groups: what could be deductible in full and what was subject to the 2% of AGI limit. The new tax law eliminated group 2. That's all.
just the majority of it.
Right. Now, so what was left? We're left with gambling losses. Deductible gambling losses are not subject to 2% of the AGI limit, so they're still in existence, so you can deduct your gambling losses. However, you can only deduct them up to the amount of your winnings. So you can deduct, if you had $1,000 in winnings, what's the maximum losses you can take?
$1,000.
If you have $5,000 in winnings and you had $2,000 in losses, how much loss can you claim as a deduction?
1,000.
None. You said
I
5,000.
want to make sure I said this right, so I'm going to re-say it. $5,000 in losses, $2,000 in winnings. That's what I meant to say.
Oh,
2,000.
2,000.
2,000. What if you had $6,000 in winnings and $1,000 in losses? How much can you deduct?
1,000.
That's right.
mhm.
You do have to keep accurate records of your wagers, you know, and what establishment you were in, how much your winnings and losses. That's why people at the casinos now like those cards, because those cards will track that for you. If you plug it in, it'll track it for you, and then you can just get a report at the end of the year.
I had several people that came to me with gambling winnings.
Uh-huh.
They were just doing the machines. Now, they don't get any kind of record of their losses. Let's say somebody got a win for $3,500, but over the course of the year, they lost $2,000. Could they keep their own record?
Let me back up one step. Are you talking about at a casino? Or?
No. I'm
Oh,
talking
just
like
regular. Yeah, then there's no way to track it. Yeah, at that point, they should keep their own record.
Okay.
Yeah,
Well,
it's
guys, yesterday I was at a seminar with the IRS about this exact topic. The casinos will track all of your activity that you use through your player's card. You can go to any of the casinos at the end of the tax year. You can request a pay summary, which will actually show what your overall winning and losses are. They can print that up for you. But things like your scratch and win cards also count. You know, so if you keep track of your cards, you actually have to keep the scratch and win cards. If they're a loss, you can hold on to them, and the cost of the card is considered a loss. But it's really difficult unless you actually get a printout from the casino, because personal records in this case are actually by the IRS. Because I was again, like I said yesterday, I was with the IRS agents who do track this for the state of Washington, and I was there with several of the casino members as well. And it's really hard to track table games because you're shifting tables a lot. But if you're playing your slot machines, they will be able to track your winning and loss. And they will send you what's called a W-2G, which is your gambling winning statement. Now, that's usually only on jackpots. So remember that if you only have winnings of like $100 or $200, it will only track that on your player's card. It does not track that on a W-2G. The only time they will send that out is if you typically have jackpots, in other words, over $1,000.
Yeah. It does.
So,
Yeah, that's exactly right. And it does, whether or not they have to send you a W-2G, they have their own rules. Certain kinds of games have different amounts when they have to send them out. But you don't have to worry about that, nor do you need that piece to pass the test. What you do need to know is what he just said. If you're in a casino, get the card and it'll track it for you and just ask for the statement from the casino at the end of the year. If you're anywhere else, like Sheila, you were bringing up, like it says here, provide receipts. So when you buy, like, you're buying lottery tickets, keep the receipts for the lottery tickets, keep all tickets that you have, keep any statements, keep any records, even if you got to sort of keep a written record. In the end, if you could show the IRS, if you were asked to prove it, your expenses that you took, and you were able to show the IRS all of this, the more you can show them, the more likely it is they'll give you the benefit of the doubt in the part that's a little bit questionable, like what you just wrote down. Does that help?
Yes.
Okay. Okay, so this is real simple. Becky won $13,000 playing a slot machine. She paid $1,000 for the cruise. During the cruise, she spent $3,800 on gambling activities and $500 on snacks and drinks. Becky also played the lottery and spent $260 on tickets throughout the year, but she did not win anything. Becky's winnings are $13,000, and she has to enter that. Regardless of her expenses, she enters all $13,000 as income. On line 21, other income, gambling from form W-2G. Remember the W-2G that Ryan just mentioned? She got one of those. There's the $13,000. Now, her gambling expenses, how much are they? Of her gambling expenses, what does she get to take?
$3,800 and the $260 per ticket.
Yeah. And
Yeah, she gets to take the $3,800 and the $260 that she spent on tickets. $3,800 plus $260 is $4,060, and under miscellaneous itemized deductions, she takes $4,060. Okay, she does not get to take the amount that she paid for the cruise. That has nothing to do with it, or the amount she ate while she was there. So none of that has anything to do with it. Roger spent $250 on lottery tickets. He won a $5 scratch-off ticket one time, but that was all he won during the year. How much can Roger deduct for gambling losses?
Nothing. He can claim up to 5, but why would he?
That's the answer, though. How much can he? $5. That's what he gets to. He can potentially deduct. He can only deduct up to what he won.
Yeah.
Okay. And you're right. In real life, would you even bother? But hey, you can. Erin plays poker every Friday night with her friends. Over the course of the year, she won $1,500 and bet $2,200. How much can she claim? Wait a minute. How much can Erin report as gambling winnings and deductible losses, respectively? So how much does she claim as winnings?
$1,500.
How much does she take as losses?
$1,500.
So which answer is correct? A, B, C, or D?
C.
You guys are all correct. That's exactly right. Completing a Schedule A, all you do at this point is you add it all together. I mean, my gosh, this isn't complicated. You add it all together, then you compare it to the standard deduction that we were talking about. So add all of your Schedule A expenses together. And where do you come up with your final total itemized deductions on Schedule A? Which line number?
Uh,
17.
16.
That's right, 17. Total itemized deductions all get added together on line 17. And then you take whichever's higher, the standard deduction or the itemized deductions. That's what you take. So David and Linda Cochran are MFJ. Their standard deduction is $24,000, and their itemized deductions are $13,891. Which one are they going to take?
Standard, 24,000.
That's correct. So that's what they would take. Seth and Katie are married. They're both using MFS on their filing returns. Katie itemizes her deductions when she filed her return. What must Seth do?
Itemizes deductions.
I'm sorry, what'd you say, Tina?
I said, doesn't he itemize his deductions too?
Yeah.
Yep, he has to. He has no choice. He has to itemize his deductions, even if it's less than the standard deduction, because when you're filing MFS, remember that under the standard deduction sheet that I gave you, that if your MFS and one spouse itemizes, the other spouse has to itemize because you get 0 standard deduction in that situation. Total itemized deductions may be limited based on the taxpayer's what?
AGI.
Yeah.
AGI. So there are situations where your total itemized deductions are going to be limited if your AGI gets too high. Have I told you the amounts are gone into it? No.
Mhm.
That's because I don't want you to memorize them. Just know this rule right there.
Mm-hmm.
We're not going to do the practice problem. I don't think you need to. That was more just for your benefit, even though we had them.
Mm-hmm.
Okay, so that is the end of that. There's one other thing we're going to very briefly go over. I need to call it up right now. Oops, hold on a second. And it's called Qualified Business Income Deduction. I'm going to push this out to you. I don't know if you guys have this, and this will only take 5 minutes to cover this. This is real simple. So I'm going to push this out to you. There it is. And I want you to save that and go ahead and print it, but we're going to go ahead and start talking about it after you guys save it. So everyone get it saved and let me know when you got it saved. You can print it out later because this is pretty simple. I mean, you can go ahead and print it out now, but this is so simple, this will take us 5 minutes to cover, and then we're going to be all done with deductions. So everyone just let me know when you got it saved, at least.
I saved it already.
Okay, thank you, Noemi.
I have it saved.
Perfect.
Saved.
Okay. All right. So I want everyone to look at your Form 1040. Pull up your Form 1040 or pull out your Form 1040 if you printed it out. Look at line 9. Let me know when you got it.
Yes, qualified business income deduction.
That's right. This is brand new. This is something in addition to the standard or itemized deduction from line 8. Line 9, qualified business income deduction, is something new and unique. So look up on your screen right now and let's take a look at, let's walk through this together. What is the purpose of the qualified business income deduction? The purpose is to give a tax break to small businesses that do not benefit from the reduction in the corporate tax rate. Okay, so what do we mean? Part of the new tax law that went into effect at the beginning of 2018 said corporate tax rates for like corporations are going to go from 35% to 21%. So that's a huge tax savings for corporations, isn't it?
Yes.
But when somebody's self-employed, do they report their income on their personal income tax return or on a corporate tax return?
Personal.
Personal. If they're reporting it on their personal income tax return, are they using corporate tax rates or personal tax rates?
Personal.
Personal. So they are not getting the benefit of this corporate tax rate cut, right? So this was an attempt to give them a tax break to small businesses that are not benefiting from that. That's the point of this qualified business income deduction. So what is the tax break? Well, the tax break is they get to deduct up to 20% of their qualifying business income, or QBI for short. What is their well, we'll talk about this, but qualifying business income. So they have a certain amount of net profit they're able to deduct up to 20% from their personal taxable income. So who qualifies? First of all, like we were using in this example, sole proprietorships qualify. That would include farmers that are sole proprietors, privately held farms. And you do know corporations can own farms too, but we're
Yes.
talking about a personally owned farm. So sole proprietorships and pass-through entities. Somebody go back a few sessions ago. What's a pass-through entity?
K1.
They do get a K1, yeah. But what is it though? What does that mean? What does the pass-through entity mean?
Means the income from your business passes through directly to the individual.
That's right. That's exactly what it means. So you might have a partnership with you and your partner together, and rather than being treated as a corporation or anything, it's the income from it, the net profit from it is going to pass through individually to the individual partners, and they do that using a K1, just like Sheila said. So, and by the way, that means a pass-through entity effectively is treated as if you're, it's almost as if you're a sole proprietorship when you're doing the tax return. So, what must you have to have a qualified trader business? In other words, what qualifies as a trader business? A trader business. Man, I'm getting really bad echo. A trader business that does not, okay? So the way we're going to define this is defining what it's not. Any trader business that does not simply perform services as an employee. Well, that one to me is kind of commonsensical. If you're doing services and you're an employee, you're not self-employed for that income, are you?
Right.
The reason they have this in here is there are some businesses that sometimes end up in the business itself actually ends up in an employee relationship. So, but this is commonsensical. If all you're doing is performing services as if you're an employee, you're an employee. You're not self-employed, and this doesn't apply. Or you perform services in one of these fields, okay? So if you're performing services in one of these fields, okay, health, law, accounting, actuarial science, which is just, it's kind of, yeah, it relates to insurance. Actuarials are where you've got guesses as far as like how likely things are to happen and how long someone is going to live. So if you're working in a field like that, performing arts, actors, musicians, example, consulting, athletics, financial services, brokerage services, investing, dealing in securities. So if you're performing services in one of these fields, are you a qualified trade or business?
Yes.
This is what gets really, give me just a second to look at something. Let me do this a little differently. I put this terminology here. This will help you. These items, this list, are considered what they call a specified service trade or business. It's a service trade or service business. So, and it's specific ones. So specified service trade or business. So a way to simplify this is you must have a qualified trader business. What does that mean? That is any trader business that does not simply perform services as an employee or is, and does not perform services as a specified service trader business. I know this is the worst part of it right here, guys. This isn't that bad. It's just you got to get your head around it. Any trader business that is not a specified service trader business. So let me put it this way. If a business is a specified trader business, will it qualify as a trader business for this deduction?
No.
No, it won't. Because, okay, so let me say it a different way just to make sure we're getting. Any trader business that does not perform services as a specified trader business. So this is a terminology that I'm pointing out here. So if you are, another way to put this is, if you're a qualified trader business is any trader business that is not an employee or a specified trader business, a specified service trader business.
So I'm a bookkeeper, so I don't count.
That's correct.
Got it.
Yeah.
Because she's an employee.
No, I'm
No,
not.
it's because she's a specified service trader business.
So,
Yeah, I know.
Health profession, lawyers, accounting, like a bookkeeper, those don't qualify, correct?
Yeah, yeah.
Yeah, okay.
If you're a tax consultant, would it qualify?
No, that's an account.
No. No.
See, I would say you do.
Okay.
No,
Well,
hey, look, guys,
Either
this is
financial
brand new
services-
law. This is brand new law. Now you're seeing how people can come into it, but it's not like a lawyer. You are dealing with law. You are dealing with some accounting related stuff, but you're not performing accounting. I would say you could do it. However, you could argue that consulting of any type falls under that. Guys, this is going to be the area where there are new law created as people run into these gray areas and IRS disallows some things and then the person challenges it and ends up in a court and a decision's made. So, but I would argue that even though I use the word consulting, a tax preparation, if I had just said tax preparing, I would argue that tax preparing is not on this list. And I would give my client the benefit of the doubt on this because I think I could reasonably take that position with the IRS. But anyway.
A CPA qualifies, right?
CPA.
CPA, what is a CPA? What do the letters stand for?
Certified Public Accountant.
Certified Public Accounting. I would say a CPA does not qualify.
Because you said a tax consultant qualifies.
Well, because they're doing taxes, they're not accounting.
This is in
Although the IRS might come back and argue, well, but you're doing tax consulting. So they might come back and argue that. Look, guys, this is what's tricky about it. Here's what I do like. On your test, I guarantee you they're not going to be that exact. They might say, oh, hey, you're self-employed as an accountant. Can you take the qualified, are you a qualified trader business for the QBI deduction? The answer is no, you're not.
Now you got these two exceptions down here though.
I know. I haven't gotten to them yet.
I know.
Very in architecture.
I know, but I'm trying to deal with these. The way to remember this and the way it really does it in the reading, well, I don't know about your reading, but the reading from the IRS and other places, they say any trader business that does not perform service as an employee or is not a specified service trader business. I broke it down this way because I think it's easier to understand, but you remember it however works best for you. One way to think about it is you have a qualified trader business as long as your business is not only an employee or a SSTB. If it's an employee or an SSTB, you don't qualify. What is an SSTB? It's in this list here. Okay, so far are we okay on what this is?
Yeah.
Okay, so let's talk about exception number one that Garrett was starting to bring up. Exception number one to an SSTB. So in other words, here's the rule, but of course the IRS makes everything difficult. There's an exception to this. Engineering and architectural services. Well, that gets sticky, doesn't it? Because didn't we just say consulting? An engineer provides consulting services, and architecture provides consulting services. So they are accepted from this. So if you are self-employed as an engineer, are you a qualified trader business?
Yes.
Yes. Because you would have gotten, the general rule says, no, you're not, but there's an exception to that for here. Okay, now, here's the big one that's going to, by the way, was it Sheila who said, well,
Yeah.
I do this kind of thing? This is going to be the big one that kicks you back into being able to claim it.
Aha.
If you're a self-employed business that is disqualified because of this general rule under the SSTB, but you're a business owned by a taxpayer with taxable income of $350,000 or less. $315,000 or less.
Yeah. 20,000 in a good year.
Right? I know you wish you were getting disqualified.
Yeah.
And by the way, all others are half that for all others. So single person, 157,500. Look, oftentimes on these kinds of things, look for the pattern because it's easier to remember. If you memorize just MFJ and know it's either, like doubled MFJ or half MFJ, that's easier to remember those things.
Mm-hmm.
So if you are a sole proprietor who's running a business that is not an employee and not an SSTB, you're going to be considered a qualified trader business. But if you're disqualified because of SSTB business, look for one of the exceptions. Is it engineering, architectural, or has your income for a single or a MFJ taxpayer $315,000, or half that for all other filing statuses? So if you
taxable income, that's not gross income for your business, right?
Yes, taxable income. Taxable income for a self-employed person is their gross income or their net profit.
Net profit.
Net profit.
The amount that would flow through that pass-through entity. That's the amount that.
That's right. That's right. You're exactly correct. Yep, you're 100% right. So, just to give this an overview again, who qualifies sole proprietorship? You got to have a qualifying trader business. By definition, that means you're not an employee and you're not providing a service in one of the SSTBs. And even if you are, you're still good if you're an engineer or architecture, or if you're a business owner that's making $315,000 or less if you're MFJ, half that for all others. So how do you calculate it? Basically, you notice nothing is as simple as it's always this way. But generally, you take 20% of your qualified business income. What is the qualifying business income? The taxable income for your business. What is the taxable income for your business? Your net profit. So, however, certain limitations do apply to the calculation. So, when you're doing it, you have to do the worksheet that goes with it, the form that goes with it to calculate it correctly. You don't want to, I'm just saying, generally speaking, you're taking 20% of your qualifying business income. Generally speaking, we're talking about your net profit. But there are some limitations that apply to this. And rather than memorize them, just know they apply, because I can pretty much guarantee you this. If you got memorized what's here on this one page, you'll be able to get this right and answer any questions on the test. So where do you report this? On the Form 1040, line 9. So any questions about QBI?
Nope.
No? Okay. So let's talk for just a moment. Just a moment. Big picture here. Going all the way back to our first couple of sessions where we did an overview of the Form 1040, and then we took a look at the Form 1040 calculations. On the Form 1040 calculations, it starts with income minus what gives you adjusted gross income?
Adjustments.
That's right. Income minus adjustments gives you adjusted gross income, or AGI for short. AGI minus what?
Deductions.
Deductions gives you what?
Taxable income.
Taxable income. So we just talked about deductions. There's standard or itemized deductions that you can take, whichever is higher. Then there's also the QBI, the qualified business income deduction that you can take. Once you subtract those deductions, you end up with your taxable income. And that's where we're going to leave you for today. We're actually going to cut it off early today. Okay. Next week, next Monday, or next session, we're going to jump into chapter 14 of your reading. And that's where we're going to start talking about the child care credit, education credits, savers credit, child tax credit, earned income credit. Okay?
Right.
All right, so we're going to get into the credits now. And we'll deal with that next week.